Welcome members and guests to the International Model Investment Club for June 19th, 2023. You can see on the screen some URLs for our YouTube channel where we post all our meetings, tinyurl.com/YouTubeVix, VICS. We also have a Facebook page. You can see that as well as our Better Investing page where we're at on Better Investing. And I'm going to go to our next screen, our background, and I'm going to get all of these showing real quick. Okay, we were founded in May 2016. IMIC is a Better Investing Model Club open to the public. We have monthly meetings that are held on the third Monday of each month. In December, we meet on the second Monday of the month due to the holiday. We use hypothetical money. This is to avoid issues with currency exchanges and taxes. And our primary role is to be a learning lab, to learn the better investing principles and the fundamentals of stock investment using the online SSG stock selection guide and through an investment club operations management through mostly through my club. All meetings are held online, serving visitors and guests from around the world. We are an international club, international community. We currently have 13 members from the United States, Canada, and China. Here is some information about how to handle this little toolbar that's on the right of your screen. It starts out on the right of your screen. The agenda is available in the handout section of the control panel. This control panel towards the bottom that everyone should see says handouts at the bottom there, and that has the agenda. All visitors guests will be muted during the meeting and may pose questions in the question section, a little bit above that, a little bit above the handouts. At the end of the stock presentations, visitors and guests will be unmuted and ask for their comments and questions. So that's at the end of towards the end of the meeting. We'll see the agenda in a moment here. Meeting segments are timed. Alerts will signal when the segment is near the end and when finished. And finally, here's our disclaimer. I'm just going to read through this. International Model Investment Club disclaimer. The information presented is for educational purposes only, is not intended as a recommendation to buy or sell securities mentioned. The views expressed are those of the participants only, do not necessarily represent those of Better Investing. Investors should conduct their own research and analysis before making any investing decisions. Securities discussed may be held by presenters in their own portfolios, and the presentation may contain images of websites, products, or services not endorsed by Better Investing or the presenters, and the meeting is recorded and will be posted to our YouTube channel. So that, I believe, covers all we want to do with that disclaimer and introduction. So I'm going to look at the agenda real quick here for tonight. We just did the first item, and we're going to cover the Treasury Report by Reddy coming up in a few moments here. Then we'll have a stock study. Isla and Jay will cover CLFD and CPRT, those two companies. We're going to have some first quarter reports available for review. We may get to these, we may not, depending on how much time we have. That's for Qualys, Schwab, and Vertex. And then we'll have some open mic from you, the guests, for your questions and comments. Then we'll do some club business if we want to buy or sell anything. And then we'll have an education topic. Our education presenter, Bakul, will be coming a little bit later on in the evening, and he'll be presenting the financial statement review from his expertise. So we'll see that later on tonight. But first off, we'll go without any further ado to Treasury Report, and Reddy can take that away. Go ahead, Reddy. I can change the presenter if that's needed.
Can you see my screen now?
Yes, we see your report, the first page of it.
Okay. I will briefly present the Treasurer's report for this month. How do we do that? Okay. This month, I'm depositing the membership contribution a day or a couple of days before the meeting so that we know the cash position and enable us to consider buying new purchases. I deposited $1,300 on behalf of 13 members 2 days ago. Last month we did not buy any stocks, but we sold two stocks, FAF and AQN. I listed the details here. We have proceedings from the sales to these two sales, 5,400 plus and almost 4,000. So that's the cash available for today to spend it. We did not pay out anyone. No member withdrawal last month. As of now, today cash balance is 10,000, close to 400, for consideration for the club members to consider buying some new purchases or add shares of the existing ones. We have not added any new members this last month. The third slide, the heat map shows Vertex is large, and because of the two sales, the cash block is also large, and others are fairly good proportionate of our total assets. I listed here summary of gain, winners and losers. I'm not considering the small percentage losses or gains. I'm listing here percentage gains and losses more than 10%. We have a good gain last month. As you see, the market is going up. Our best stock doing is Vertex Pharmaceutical, and I did not get a chance to review today's analysis. Somebody sent it on Vertex, but it's doing good. Schwab and Facebook and Freeport McMoran are doing good, and we have small gain from Qualis. I think I looked at Qualis presentation that is going to be done today. Qualis looks good, and I do not know why we considered selling it a month ago, 2 months ago. It's a software security company, and we have three losers, small losses on Amazon and Disney. I'm not too worried about those. But innovative industrial properties, some last 6-7 months, people are doing some negative articles on that one, and that's why it is down in my view. I think company wise it is still doing good. Next one is, this is the summary from the club website. Oh, by the way, I got a notice, John or whoever is taking care of, please renew my membership, otherwise I have only 1 day. If this meeting is tomorrow, I would not have been able to participate. Okay, you can see the 5 reds, and the rest of them are green. I think our the gain loss picture improved a lot from last month to this month. And here this shows, you can see the blue one here is our club compared to other two indices in green and some other color. The market is picking up, and we are doing good with our stocks in spite of the two sells that we had last month. Okay. Yeah, indices are Vanguard 500 and Vanguard Total Stock. This is the PERT summary. We have still a good number of pink cells with negative numbers, and I think because market was down last year, but things are improving. Picture is improving. Again, the price dates are as of whatever the dates we update our SSGs and link it to the website. Okay. Next one is club assets. we sold 2 stocks. So we have little, everything is a little bit bigger pie, and roughly about 5% is the lowest, and the highest is Vertex, 22%. Other than that, we have large amount of cash. As you can see, 15% of the portfolio is cash. We can consider buying something today. This is a sector map, and we have fairly good representation of the small, mega, large, and mid cap. I don't think we need to worry about these sector representation. And this one is the sector diversification. We have communication is the largest sector, but I started listing this few months ago. The sectors that are missing out of 11 sectors, these 4 are still, we do not have any stocks in these sectors: consumer discretionary, energy, industrials, and utilities. We can consider, but we have to do the homework before we do. I think we are not just paying much attention to our watch list. We used to a long time ago. Watch list helps us to consider buying new ones in the missing sectors. The last slide is diversification within the sectors. And biotech, because of the Vertex pharmaceutical, is high. Internet content is a little larger, but all others are fairly good percentage. Lowest is close to 5%. Any questions?
Ready on slide 9. Slide 9.
Yeah.
Algonquin still there. Algonquin need to be removed. 5%.
Where? Oh, this one. I generated this after sold it. Why did it include that? That's a good catch.
Yeah, also FAF too.
Yeah, I first entered all the sell, then I created the treasury report. Yeah, that's a good catch. I checked the. In fact, I have it still here. Club accounting. Okay, club. We'll go back. Algonquin, okay. In my present list, it does not show. You can see here, it does not show. Okay, I'll check that one. This is the list.
That's okay. No big deal. Just wanna make sure.
Yeah, well, that's a good catch. I'll check why. I did this in the sequence. First I sold, then I added the membership, then I created the user report.
Yeah, no big deal. Just you can fix it next time. Yeah.
I will look at it. Yeah.
That's all the comments I have.
Yeah. Okay. Any other questions?
Thank you, Reddy. I think we can move on.
My general comment is, I don't know, we used to spend a little bit time on once in a while, at least on quarterly basis, digging more details on the PERT. I don't know how to do it. Bernard Coville is gone, and what is the other one, gentleman? It's a good idea to spend some time why these pinks are still pinks, and can you do anything about it?
What's really important, though, is that on the left, you'll see that people have not been updating their SSGs. So Piero, your last update was May 2023. Joel, May 2023. Megumi's is not linked. Hanny's 5/2023. John Catterson, we might have to, let's see, Ready, you and I have updated ours.
I'm trying to be a little cautious because I reminded a couple of times the last 2 months.
Yeah, and
Joanne,
Joanne?
I have a suggestion. Go ahead.
Question. Under Disney, you'll see my name, and it's got 5/14/23. The last time I updated. What do I need to do to get that?
If we have time at the end of this meeting, we'll go over it again.
Thank you.
Okay.
Can I ask a simple question, Joel?
Sure.
Yes.
You go to your SSG for Disney. At least minimum update the price, and then link it to the website.
Yeah, Ready. We're going to go over it at the end of the meeting if we have time.
Okay.
Okay. So let's hand it over to Jay. Let's let Jay and Ilam do their presentation.
Okay. Thank you. I'm going to talk about how Isla and I decided to study the companies that we're going to present tonight, Clearfield and the Copart. I want to talk about, we actually was going to, as Deborah is our guest, she's an attendee. So she was being with us, and we tried to look we actually started look companies size and try to figure out, okay, what's missing? Like Reddy was talking about in his treasury report, was saying, oh, there are these are the sectors that we don't have any. We started do the screening, use the SSG tool to screening. And then Deborah was saying that, oh, TikTok, the Clearfield sounded like it was very popular right now in BI. Everybody was talking about that stock, which Isla will dive into more. And unfortunately, both Isla and I were not at the February. We did not know that stock was presented in February because both of us were absent that month at that meeting. So we did not know. We got very excited about that company. Then we find out that it was not get presented, and we noticed that the price got dropped significantly. And so Clearfield is a small size company. And we noticed the presented in February, and we noticed that the price dropped. The time that we were doing the study was in May, dropped us over 60%. And and I try to figure out what happened. I contact Anitra. We're talking about that did not meet the financial ratio criteria. And I remember the Copart that presented last October. I remember who it presented. I don't remember why we did not buy that company. The price keep going up to 63%. So we thought, okay, let's find out what just happened to this company. I can show you briefly. Look at the SSG, the first page. The upstream parallel. The graphs look so great. The SSG looks great, but one stock keep going down and one stocks keep going up. And we thought, okay, why do we just look into their 10K, 10Q and dive into more to how to research, find out what happened to these two companies. We thought it would be a great example to show SSG just tells one side of the story, gave us some fundamentals, but then we need to dig deeper. Actually, Clearfield right now, price just picked up again. But at the time we were studying, it was like a 38.65. That is our history of why we picked those two companies. Is not for us to recommending buy or sell at this meeting. It's just look at two great-looking SSG companies that how can we learn more from their financial statements. So Isla's going to do the Clearfield first. Isla, should I just flip the pages for you, or would you like to have a control?
You can do it. It's fine.
Okay. All right. Okay. Go ahead.
So we saw that first picture, that's from the website at Clearfield, and it's just a representation of how much they participate in sharing data among all the different sections of our society. So Clearfield was founded in the 1980s as AmeriCable, rebranded in 2008, and their website is cclearfield.com. Now, the reason I bring that up is because there is a Clearfield Software Limited located in Auckland, New Zealand, and their website is clearfield.com. So anybody who's looking for it has to look for C Clearfield to get the one we're talking about. So Clearfield makes components that connect fiber optic cables, and through that, they allow wireless reception of amounts of data and communications between their towers. Clearfield invests a lot of money in R&D, and they frequently introduce components that help reduce installation and repair times for their customers. Their customers are primarily digital networks and cable operators. Wait, go back.
Oh,
Yeah, so Clearfield acquired a company called Nesta, which is a company in Finland, and they make similar components to the same components that Clearfield makes, but they also make fiber optic cable. So now Clearfield has all of that they're able to manufacture. Next screen. This is a picture of the visual analysis of the current SSG for Clearfield. It really looks wonderful. So based on this extraordinary growth that happened in 2021 and 22, higher revenue, income, and earnings growth, Clearfield became very, very popular in the better investing community. In fact, there were 513 SSGs were completed between March and June, and there are probably more now. Very, very popular. Vastly increased customer orders. Why were those orders increased? The customers of Clearfield decided that they needed to order large amounts of all of the components so that they would have them on site so that they could avoid any supply chain problems. And the pandemic meant that since everybody was at home, it was more important than ever that these digital operators and cable operators keep the data flowing so people wouldn't go out of their minds while they're stuck at home. Okay, so next slide. So their price was starting at $13.99 in July of 2020, and it peaked at $132 in November of 2022. Prior to their Nestor acquisition, which occurred in the middle of 2022, Clearfield had no debt, but they got a line of credit, they paid for Nestor, and their fiscal year ends September 30th, 2022. They announced their results in November, and after their fiscal year results were announced, their share price rose to $117, and then through the rest of the month, it peaked at $132 on 11/23/22. A couple of weeks later, on December 6th, they announced a new offering of 1.2 million shares of stock, and their share price dropped from $110 to $103 in one day. So there were other declines that happened with Clearfield over the next several months, and there were a number of different reasons. Externally, every time the Fed raised interest rates, every time Jerome Powell made any public comments about the economy, anytime Powell testified in front of Congress, most of the market indices dropped and lots of companies' share prices went down. Clearfield was no different. Internally, as you saw, as I said, the results in 2021 and 22 were great. But Q1 and Q2 of fiscal year 23, the results showed there was a slowing in revenue growth. There were decreases in the number of orders they were getting, and there were increases in the amount of inventories that they had on site. Q2 also, they had a downward revision of their guidance revenue for 2023. So resulting, their closing price on May 1st of 2023 was $35.27. So this is a look at the table of financial ratios that was showed during the February presentation. The only addition is the column on the far right for current. So you can see that at 18, 19, and 20, some of the ratios were coming up, but the difference between 20, 21, and 22 is very, very significant. Some of those ratios are still holding. They're dropping a little currently over Q1 and Q2, but there's a significant rise in 21 and 22. Next slide. So this table is just a look at what has happened over the last 10 years and whether or not Clearfield has been able to meet the threshold, satisfy the threshold, or fail to satisfy the threshold over the last 10 years. As you can see, for the most part, they have failed. Now, the top 3 ratios are the most important ratios. Those are the ones that Bakul says speak to the quality of the company. If a company has failed 2 of the top 3 ratios in any one year, he advises not to continue researching the company. It will not be good for your portfolio. If over the course of 10 years, 2 or 3 years, 2 of the top 3 ratios are not met, he also advises not to continue. Clearfield passed the top 3 ratios in 2022, but that was because they took on debt and they increased their share count. So as a result of that, their return on equity, return on invested capital, and their return on assets all went up. But most of the fails occurred before 2021. So cash flow and balance sheet and income observations. Cash flow, there was an increase in investment in property, plant, and equipment, along with the business acquisition. There were no dividends paid. They did buy some shares back for tax purposes, but it didn't have a very big effect on their share count. Their cash from operations turned out to be less than their net income, and that was because they had increases in accounts receivable, inventories, accounts payable, and stock-based compensation. And there was a significant increase in proceeds from investments. The balance sheet showed an increase in cash and cash equivalents on the asset side, increase in inventories also on the asset side, and an increase in shareholder equity of 106% from 2021 to 2022. The income statement showed, again, an increase in net investment income. That net investment income increase allowed their net income and their earnings per share to pretty much equal what had happened the year before. The share count increased from 13.9 million in September to 15.2 million in March. So my point of view about this company is that their growth is both organic and by acquisition. They don't do acquisitions often. In fact, they've only had 2 in about the last 10 years, but most recently they did have an acquisition. They increased their share count. This was not beneficial for anybody who was a shareholder of theirs prior to December of 2022. Their free cash flow ratios look terrible, but that is because they've had multiple quarters of negative free cash flow, which is why they needed to borrow the money to complete the Nestor acquisition. So looking at financial statements and financial ratios gives investors a way to assess their past growth, if that past growth is solid, and whether or not that growth will continue into the future, and that's a look beyond the SSG. And that's it for Clearfield.
Do you guys have any questions?
I do, because
Okay.
it looks like from the 532, it looks pretty good.
It
So
does.
I'm not understanding. Okay, but on Bakul's financial ratios, can we back up a little bit? Yeah, on this one. So you have 2 points. 2 failed to the top 3 in 1 year, and 2 or 3 failed
Right.
of the top
Over the course of 2 or 3
10 years.
years, over the course of 10 years.
Okay, so when you say in 1 year, is that any year? That first bullet?
So if you, all right,
failed?
yes, if you're looking at only 1 year, let's say you're looking at 2022, you're looking at the results for 2022, and you look at the top 3. If 2 of the top 3 fail in 2022, then that it would be advised not to continue with the research.
Okay, so is it because of this, of the financial ratios, that the company isn't doing? I guess I'm not understanding. With the 532, it looks like the company, and looking at the SSG, it looks like the company's doing well.
It is doing well, but the problem was, I'm sorry, go ahead.
No. So I'm trying to understand, why is the stock price dropping so much?
Well, mostly because of, again, because of the Fed hikes. You notice that every time they hike, every time the Federal Open Market Committee meets and they report, most of the market indices drop, and most company's share drops, and so that's what happened to Clearfield also. And then anytime Jerome Powell speaks to Congress or anytime he makes any remarks on the economy, those market indices drop again and share prices drop. Some companies can withstand that. Clearfield really couldn't seem to stand that. Clearfield ran up significantly because of the increase in revenue that they had over the last 2 years, but that was really, I think, more exuberance because now we're in a place where the increased orders that brought that increased revenue and income to them are not happening. So even though it
Okay.
looks good now, over the course of 2023, I think there may be a significant change.
Okay. All right. So that graph might change then.
Yes, it may drop down significantly because the companies that are their customers are not ordering in the same way that they were during 2021 and 22. They're ordering pretty much the same way they were in 2017 and 18, which is significantly different.
Okay. Great. Thank you, Isla. Good presentation.
Question regarding the 532. Would you go over what that means?
Oh, okay. So Bakul and Ron, who is no longer with us, came up with the idea of looking at the financial statements. And when you look at the balance sheet, the cash flow statement, and the income statement, for the cash flow statement, you should be able to figure out 5 significant things that you can pick up from the cash flow statement, 3 significant items from the balance sheet, and at least 2 from the income statement. And based on those, all of those together, you should be able to come to one point of view, but because I'm a little gregarious, I could not come up with only one.
Thank you.
I have a comment on both Clearfield and Copart.
No,
Clearfield
just Clearfield right now. Yeah, just Clearfield, because we haven't done Copart yet.
Okay. Clearfield is included in the investing small cap informer, but then they recommend buy price is $31 and sell price is 46, and current price today is 49.
Right.
So it's clearly my view is clearly don't touch it, don't bother about it.
I believe we discussed with Isla and Baku. I don't know, Ella, you remember. Baku was saying, basically, we just need to watch this company. You probably want to wait a couple more quarters just to see what's happening. Yes, the price went up from the last time, May 26th, we met a few weeks ago. Price went up, but it's a small company. We just have to watch and see.
Yeah, it's very volatile. In other words, because it's such a small company, the price is very, very volatile. So just as G just said, we should just watch it for another couple of quarters just to see what it's going to do for the rest of this year. Because their fiscal year ends in September.
Well, my general question is, should we bother as a club to worry about such volatile companies?
This is not a speculative company, right? You look the graph. It does have you look the graph. Let me see. It's not
price dropped.
It has
not
price got dropped, but this company has some sort of a quality. But we know that price got dropped to almost down to the 52 weeks low. And we just have to be patient a little bit to wait for kind of a couple more quarters and to see if it will be a solid company to invest for long term.
Jay,
Can
you click on free cash flow on the free cash flow line? Yeah, it's on the left. Yeah. Okay.
Clearfield has had multiple quarters of negative free cash flow.
Okay.
Which is why they needed to borrow the money to complete the Nestor acquisition.
Oh, okay.
I have a question. Oh, go ahead, Anitra.
I'd like to share that when it first was introduced, pretty much to me, when BetterInvesting was when I think it was Manifest Investing did it in February. It was $76. They bought. They don't use real money, but they bought, for their books. And they bought, I think, $1,000 worth of it. And then I thought it was really interesting because it's a field that I knew a little bit about, and I felt that it was growing. I felt that it didn't take off because of backlogs. They have a lot of backlogs that they're not fulfilling as well.
Right.
Also, when I did the presentation, which was my first one, it was really scary, but
well done.
Thank you. I get the fact that I don't remember Bakul being on the call, but I do remember Ryan being on the call, or at least I thought I did, but it came out that it did not meet the requirements. However, another club, a younger club, did my original club did invest in it, but the way they did it, they bought a small amount, let's say $500, at the regular price. I think at the time it might have been 43, 42, something like that, between 42 and 45. Another 500 at, let's say, 37 on a limit order, and then another 500 at another order at another rate. But it never got low to the 30s, but it did get low enough for that second limit order to kick in. So what I'm saying is, if we find a company that is, and it worked, if they got it, if we find a company, or if you find a company that you think is a good company, it may not meet everything, but you see potential. If you catch it that low, it was right around the time that Jay sent to me and told me it's 37 something. If you put a limit in order in, you would catch it. Do you recommend putting limit orders in? Maybe not on this one, but on something that you see may have potential?
Yeah, absolutely.
Oh, yeah.
I would.
Yeah.
I would.
Yes,
A
I would
low
think so
price
too.
is better.
Yeah.
Jay,
Uh-huh.
can you update this? This says 2/19/2023.
That was I imported. We did not do a new. I did a new for Clearfield, but this one is an Antitrust. I imported. I used exactly I think the 5% of what you put in, right, Anitra?
No, I didn't go that low. No, I didn't.
Oh, I don't know.
I don't remember, unless that's what we did as a club. I don't remember that being it. But
Okay.
yeah, but
I think we used
will say that Amazon also was not a company that met any of the requirements. But when we looked at Amazon, I'm sorry, it was $89. It's now $125. So sometimes being newer, when you see a company that's going to make money and yet they don't meet the requirements, so it's still a no?
Well, I would not say that. Amazon, I have a regret myself. So for example, as Amazon, you look at yourself. How many of you, just yourself, individual, have you ordered stuff on Amazon? How often do you order from Amazon?
I just ordered 2 times yesterday.
Right. So that's another thing that with a company
But here's the other thing. Everybody knows Amazon, and everybody knows Amazon's story now. So everybody thinks Amazon is always going to go up. So Amazon will always be able to sell stock.
Not necessary.
It is not 15 years ago when Amazon was just starting out.
Right.
Amazon has a track record now.
Yes.
Anitra?
Yes, I'm listening.
I have a question, and you don't have to answer me right now. You can always come back to me through email or something. I owned a small the fiber optic company for a few years, thinking that it's a good because I heard through some other BI club, and I bought it and I lost my shirt. Fiber optics company, okay. Copart is Clearfield is also fiber optics business, small company.
So what happened? Ready?
How fiber optics is not doing well, okay. I don't know why.
I think that I get what you're saying, and it's still taking a long time for it to happen. But I do know with the I feel like there's an explosion in building where I live. There's an explosion in building, even though the market the housing market is not the same as it was a year ago, but people are moving to rural areas, and these rural areas don't have 5G, and I think that is going to pull it up because they do need 5G. It's just like AT&T. AT&T and the other companies, they don't always do well either, and yet you think they would because they're giving a product that everybody thinks they need, want internet, entertainment, and such. So,
Yeah.
and yet
They do, yeah.
they don't always do well. And so it's a hard industry. But the reason why I thought this one still I did buy some stock in it. But even though I think that this one has better potential, and it might not be now, it may be within a few years, is that these areas are growing. People are moving back to small towns like Reba McEntire. She just moved to a small town. Now she bought there. She is starting a business. Everybody's flocking to that small town. And what are they going to need? They're going to need 5G. And that's the way, but that might be emotional. But I went to Bink, by the way, and there was a class on, not buying out of emotions and things like that.
Yeah, but there's a
Too late.
difference
Hey,
between
Most of it,
five. Yeah, I know.
But you know what? You know what else, Anitra? You know what else, Anitra? It's not just the small towns. There are a lot
Yeah.
of cities. I live in New York, and you think we have everything in New York. Well, we don't have everything in New York. My neighborhood is just now getting a ton of new towers so that 5G can be brought to my neighborhood, because up until this point, we haven't had 5G in my neighborhood. So, and there are many other neighborhoods in my city that don't have 5G service, or they have very intermittent 5G service. So there's a lot of infrastructure yet to be built out for 5G. I think Anitra is absolutely right about that. And it may take a while for this to keep going, but I think she's absolutely correct that this is one of those companies that will benefit from that buildup of infrastructure.
I want to understand 5G and fiber optics are two different things. So fiber optics.
No,
and
5G is just like the speed with which and the amount of
Right.
data that can be passed.
Yes,
So with
mine is
5G means that it's a lot more data, but it covers a smaller area. So the distance between towers has to be shorter. So
Right.
you're going to see, I'm beginning to see huge towers on busy street corners, which never would have happened before.
I think we presented the 5G technology before. What I'm trying to say is when Anitra was saying brought stuff into small town, that doesn't mean they brought a fiber optics back. However, personally, I do prefer fiber optics, but I don't have it. I have an AT&T. I used to have a Comcast. They don't have it.
Yeah.
I would prefer. So I just want to, for definition purpose, I just want to make sure that that's two different concepts.
Well, 5G is about the transmission rate.
Mm-hmm.
And the rate and the amount of data that they're transmitting. The fiber optics is just the physical part that does some of the transmission.
Right, like we use a cable, some use a fiber optics, we used to use cable.
Yeah, and the thing for Clearfield is Clearfield now not only has the connectors, but also they have a company that makes the fiber optic cable itself. So
fiber optic is the fiber to the node. The node is the business, whether it's a big business, a small business, fiber to the home. That's the fiber. It's actually the wires that's putting the energy through it. That's the fiber optics. And each tower has like 1G, 2, 3G, 4G, 5G. The larger you get, the more cells are in that tower. So you may have 3G that might have had, I'm just going to give an example, might have had 50 cells, where in 4G might have had 70, let's say 500 cells, and 5G may have 1,000. Those numbers are not accurate. It's just an idea of how more cells give more power, give more power
more
without
data.
breaking
More data.
More
data.
And
Anitra,
so you can stream movies anywhere.
Anitra, I'm missing some basic thing. Okay, the fiber optics is a cable. Okay, 5G is tower every few other houses. There is a tower. It's a wireless. I'm missing something.
It's not very few other houses unless you got a lot of land.
Okay, but the 5G is based on the towers, many more towers, and it's wireless. But the fiber optics is cable buried underground. Okay.
Right, it's ideal underground, right? To
Ideally,
be
right.
protected from failure. Yes.
Yeah, and we are. I think we are mixing up the two. I'm confused. Why this is a company? Clearfield is a fiber optics company. That's a
Right.
cable.
Actually, they started out as a company that makes the components that connects the cable. They didn't used to make the cable, but now they own a
Yeah.
company that does make the cable.
Why are we bringing 5G and all that stuff? Which is wireless.
Somebody just had the question. I think they just were wondering how, what it meant. I don't think it was just about Clearfield itself. It was, but Clearfield is connecting the fiber to the node, which is the fiber optics to the tower, and to make it so you can get the energy to stream, to connect your medical devices. Some people might have a pacemaker. Pacemakers need to be monitored by Wi-Fi sometimes, and other medical devices in companies and hospitals and all of that. It's like they really, it has to happen.
Well, it's very similar to a company running a wire into your home, right? At some point, the wire comes into your home. However, you can use your devices inside the home in any room without it being attached to a wire, because you now have Wi-Fi.
The Wi-Fi within the house is different.
Wi-Fi but that's brought in by the wire. The initial wire connection is what makes Wi-Fi available in your house, that you can connect your various devices to wirelessly.
For some reason, the wired companies are not doing well. I got burned by one company which is the same fiber optics business few years ago. It's doing lousy. Okay.
Yeah, but not all. Okay, so whenever something new comes along, there are going to be a ton of different companies that do it, and not all of them are going to make it. Some of them are going to make it, because look at the whole the internet bubble and all the companies that decided that they could sell stuff on the internet. Who's left doing it now? Amazon. But there were tons of companies that could sell anything you wanted on the internet: baby diapers, baby food, anything at all, tires, whatever. But now Amazon sells all of that stuff, so Amazon prevailed. There will be some companies that will make it.
Okay, I want to interrupt. I'm going to interrupt the conversation so that we can move on to Coparts.
Copart, yes, sorry everybody.
No, it's good discussion. And I think Anitra will be a perfect stock follower if we're getting to communication equipment. She sounds like a
expert.
I just looked at Anitra.
She's an expert. Yeah. She helped us all. Thank you.
I'm still learning. I really,
Well, you know more than the rest of us.
Okay.
Right. I just looked at her bio. She did not submit her bio. We need to give her bio fill out. I
appreciate listening to the presentation of Clearfield tonight, because it was fast, it was quick, it was to the point, and I was thinking that's what you guys want from me, and that's what I need to learn to do.
Yeah. Okay, Copart, look at the graph. Sales, earnings, pre-tax profit, beautiful, upstream parallel. This company also is being voted as the best long-term growth potential company. So I just saw that on their award. I thought, oh, that's a good thing. So I'm so sorry, something wrong with my. So Copart, also founded in 1982. It was very close to where I live. Started a single yard in Vallejo, California. So they offer services to sell vehicles to dealers, dismantlers, could be even bank or insurance companies, and on online auction online. And they They could also sell on behalf of insurance company, bank, financial finance companies, charity, as I listed here. They are selling over 265,000 vehicles online every day. At least they're available online every day. You can bid in real time. They sold per year over 3 million vehicles. They have 750,000 members, and the buyers is in 190 countries. They are having 200 locations. They operate their business in 11 countries. What drives their revenue? I just dig a little bit more to try to understand the business. So how they making money is that they are auction related sales transaction fees. Also, they deliver storage fees. That's how they make money in US, Canada, the countries that are listed below. For UK, Germany, and Spain, they operate both as an agent. They are purchasing salvage vehicles and resell the vehicles in those countries. And in Germany and Spain, they also list the vehicles on behalf of the insurance company. And the insurance experts will determine how the vehicle is valued, how should sell for the insured price. Their growth strategy is that they are acquiring and develop new vehicle storage facilities, including foreign markets. They are pursuing internationally, not just regional, national, global vehicle supply agreements. They are all their online auction services and real-time access sales data, real-time bidding. They have the software that does that. Something called third. I can't remember the kind of software name, but it's a software that helps them to doing that. So I also did the 532. Bagu will join us later on. He will present these two companies at 532, cash flow statements. So mostly this company's internal growth compared to they do have acquisition, but they spend 3 times less than in acquisition compared to the internal growth. For their plant, PPE, one more time, plant, property and equipment, they decreased 37% compared to 2021. They have so much money, and they have a cash payments of 400 million in 2022. They don't pay dividends, and in 2022 also they don't have a buyback shares as well. On their balance sheet, the 3 things that I focused on is the asset. So the asset increased 16% compared to 2021. The liability decreased 34% in 2022 compared to 2021. The equity increased, which is a good thing. It's a very healthy balance sheet. So as Bagu was saying that that's just like your house, right? You have assets, you have liability, and you have equity. So the assets is always equal to liability plus equity. So it is a very healthy balance sheet. On their income statement, their revenue increased 30%. The net profit margin exceeds 10%. So it's a very, they have a money. So that's their financial statement. And for their financial ratio, I did not list the 10 years. I list the overall. The reason being is, as you can see, number of satisfied at 10 years. The return on equity is all of them greater than 15%. So ROIC is all of them pass. Free cash flow per sales, 9 out of 10. So top 3 are passed. The thing that they did not pass is capture expenditure per sales and free cash flow per net income. The gross margin greater than 50% is almost impossible. I don't know why. I'm so curious to hear from Bagu why they want to list gross margin to be greater than 50%. Almost impossible. So the rest of the operating margin, net margin, they all pass. Return on assets, they all doing great. Financial ratio. So my point of view is this is an organic grower company, and they use cash flow to finance and grow their business, which is great. And then the top three on the financial ratios are met. Those are my point of view, and that's it. Do you have any questions for this company?
Question.
Yeah.
On Bakul's measures, or you listed 10 on Copart. It was 10 years of pass versus Clearfield. There were 6. As a club, do we look for 10 years of
10. Clearfield also is 10. Oh, I don't know. I believe this is a 10. We did not look I think what, Ella, do you remember why you asked?
I think Bakul said we should look at 10 years.
10 years. I don't know why. I think if I remember correctly, Ella just copied the what in February what you had. We just copy paste, but she did it.
But you know what? In terms of where you get this information from on Morningstar, they will give you 10 years worth of data.
Yeah, 10 years. So this is 10 years.
Yeah.
Yeah. I think
so these 2 little tables represent a summation of the whole 10 years.
Right. I think that he wants, I believe Isla want to show you was that prior to 2021, it did not look good. It looked good only after 2021, just 2020, year 2022. She just want to do a comparison. So for me, so this is a 10 years, by the way, 2855, those are 10 years. It is 10 years comparison. So for me, I did not need to list all 10 years because they already look amazing. So I did not list the details. The details are in Morningstar, as Isla said.
Okay, so Bakul, just a summary, Bakul's measures should be passing for the last 10 years. In order to have it pass, it has to be passed for the 10 years.
Yes.
Okay. And what was the criteria? You initially said there is a barbed wire underneath the first 3 items have to pass for 10 years or for the last year?
2 out of 3. 2 out of 3. At least 2.
If you're looking at only 1 year, then at least 2 of the ratios have to pass for that 1 year. If you're looking at the whole 10 years, he says then you have to pass, they have to not fail 2 out of 3 years of the 10 years.
Not fail.
So if they do fail 2 of the 3 years out of the whole 10 years, then don't worry about it.
Don't worry about it. Just move on from this company.
Find another company.
Yeah.
Jay,
can we see the SSG? Can we see the SSG on Copart?
SSG, yes, I can show you the SSG. So I was looking at, just
nice.
Jay, I have 2 companies.
Wait. Wait.
That's like let Joanne finish. I did the SSG. Go ahead.
Is this in the buy zone?
No.
What can we see the second
buy zone? Yeah, I was going to show you free cash flow. You asked
free cash flow. That looks a lot better than that.
Yeah,
so different from Clearfield.
And also, I want to tell you, and look which year? 2020, the COVID year, right? And what else that he asked us to look at? I forgot. Was the non-sales. So this company did not impact by COVID at all, as we know, right? Used cars, the value went up. There was something he asked us to see. The line was very similar. They're all just going up.
And Jay, I'd like to make a comment that the variance between low price and high price for every year is a much narrower than the Clearfield. Like if we look at the Clearfield SSG real quick, click, see how the low and high price really like
30 to 134.
Yeah, it went from 132 to 35. So
30 to 135.
Very volatile there.
This. is for this one is 89, 51 to 89. Yeah, I told you guys I missed the 51. I thought, oh my gosh, yeah, I missed the 51, I missed the 70. Yeah, price keep on going up. So for myself sake, I did a new SSG. I did not find the company's guidance, and I looked a value line, my number mostly based on value line. I looked a few analysts projections. I did I tried to redo the judgments, but right now still this company's a bit expensive as a hold. Look at the PEs, how consistent. 34, 30,
Right.
35,
Yeah.
just beautiful, very
Yeah.
consistent.
Yeah.
And a price, I did this, why did I do 46? I can't remember. Maybe 2021 low stock price. I don't remember why I did that. I could select the 50 as well. So it's not in a buy. We just also just for our own sake that you know, just like this is another typical one that you want to put a limit order.
Yeah. The price has just
So
gone
right
up so
now,
much. Yeah, that's
yeah,
why.
yeah,
The price has gone up
yeah.
so much.
Mm-hmm.
I think, it's one of those companies, again, that just like G said, it's not affected so much by what happened in 2020. It's been pretty consistent and people appreciate that. So they've been raising the price. I mean, a lot of other companies have been going up and down, just like Clearfield. Every time somebody from the Fed speaks, everything drops. So,
Mm-hmm.
and
Obviously for this,
Powell is scheduled to speak again this week. So we'll see what happens.
Yeah, obviously this company has international business, right? The currency exchange, everything also will impact their revenue as well. But overall, this company is a very well managed company. The quality just shows us that.
Jay,
we
we
need the
don't
price to
know
come
why
down
we
for
didn't
one
buy
day.
it in 2022. Why
I
didn't
don't
we buy it?
remember why we didn't, Hoyle, because I looked at your first cut. Why we did not buy this company? Do you remember?
Does anybody remember?
I forgot why we did not.
Yeah, I shared his first cut, and I don't remember why we are not buying this. I remember where did the study.
Because we were short-sighted.
Okay, where was?
We were
Does he
short-sighted.
suggest to buy? He suggests to buy. I don't know why.
I know Jay is not giving me chance, but Copart is a good company. It is in the Better Investment Investment Advisory Service newsletter. It was a good buy, and now it's in the hold region, slightly in the hold region. Okay.
I know why I did not buy. The price
Why?
was not the buy price.
Yeah, it was too high.
It could be. I don't remember, but just
I think that was why it was. The price was too high.
Yeah, 107 and a hit.
It seems to happen that by the time we find out about companies that are really, really good, that's already been priced in. So sometimes by the time we do all the research, price is out of the buy zone.
Yeah, and based on Hoy's projection returns only 10%. I don't remember what he said. I just look at his first cut, gave me some ideas. Yeah. So anyway, yeah. Well, this one definitely is on my watch list. It has been on my watch list.
Definitely.
We're just waiting.
Yeah, just have a little price drop for a day or two. That would be nice.
Yes.
It was 107 then. What is it now?
87, 88, 87.
That's one of the, and they still may not be low enough, but if it's 87 now, I wonder how low did it go? Because
it's almost at its 52-week high.
50, yeah, they dropped.
It's almost at the 52-week high. So yeah.
It's at 52-week high now, but it was at 107 before. I don't get it because it's seemed like the bar is not at 107. That's why my question. Yes, sir.
Anitra and others, this company has been going up steadily since September 22 or so. Okay. And we are really missing buying this, but okay.
But if you had put if we had put a limit order in, maybe when it did drop, maybe it could have been caught. I'm just wondering, because what I hear you guys saying is this is a good company. It's a solid company, has a great foundation, but it did drop. But like Isla said, we forget to, we're not watching it on that day
Right.
it drops.
Mhm.
So the
Yep.
only thing to catch it would be a limit order of some sort. It still may go, the limit order could have been for 85 as an example, and it could have been 86 and went back up. So it'll never be perfect, but that's
Mitra,
only,
it did a stock
Guess
split
what?
on November 4th,
Yeah,
2022.
what
guess what?
happened?
Yeah.
It did a
What
stock
happened?
split.
6 months ago,
It
it
did a
was
stock
61.
split. That's what
But
the price took
here's
away from it.
Oh,
here's
did a
wait,
stock
but
split. Oh, thank you. That makes sense.
yeah.
Yeah.
Okay.
But also,
Guess
since
what?
we don't use real money, we don't have a brokerage who's watching.
Yeah.
So
Oh,
putting a limit order would require Ready to watch every single day.
that's
No, you
true.
can put in
Okay.
Yahoo. You can put in the Yahoo or something. You can,
So you need like
yeah.
a mock account somewhere.
Yeah. We actually,
Okay.
when our club started, we use Morningstar as a mock-up account.
Oh, one thing
Yeah.
I do remember from either Bakul or Ron saying that, yes, that don't go with a stock that is questionable, because there are so many stocks out there that you can go with. You can find a good stock. Don't settle,
Right.
and that
Right.
has stuck with me a lot. And a lot of times I might make a decision that I am settling because on that day, that's all I have. That's a personal, but as a group, we're learning to not settle and to look for the best. And I think it was Ron, and that has stuck with me forever. I mean, I hear his voice. That's what he says.
What did he say? Can you repeat again?
Don't
That
settle.
don't settle. Yes, that if it doesn't meet the requirement, there are a lot of stocks out there
Yeah,
that
that's
you
Baku
don't
said the
have
same
to.
thing.
Yeah. Mhm.
Yeah. So actually, Baku is online. I don't know, but he's muted. Oh, hey! Baku's here.
Hi, can you guys hear me?
We can
Yes, we
hear
can.
you.
We can hear you.
I just joined. How are you guys doing?
We're doing good. How are you?
Good. I'm on for the last 30 minutes or something. Is that what it is?
Sure.
You can
Are
go
you ready
before
to
that
present?
if you're comfortable. Yeah.
Oh, I'm
I
gonna make you presenter, Baku. Okay.
oh, okay. All right.
Are you
So
ready? Okay.
yeah, let me see.
Did you hear our conversation?
No, I just got in. Sorry.
Oh, it's all right. It's all right. I'll show you our slides anyway. We just discussed a bit more.
Okay.
Yeah, members ask some very good questions. We just have a great
So
discussion.
yeah, just show me like what you guys have been up to. Where am I starting? So and then I can.
Okay. So Ayla and I each presented Clearfield and then Copart. We finished our 532 and financial ratios and then and a point of view.
Right.
So we told the members that your education topic is you present these two companies 532 at your point of view.
Yeah, that's fine. Yeah.
Okay.
So when you and Ayla presented, did the members have any questions along the way?
Yes, they had a question.
And were you able to be confident to answer that, or you were saying something?
So
We got it for the moment.
I think ask Joanne, Anitra, do you think we addressed your question? Hoy, what other
Yeah,
questions do you
yeah,
have?
I think you answered them confidently.
Yeah.
The ratios, 10 financial ratios, that was really clear. I think that we're still, the 5321 is still kind of a mystery to me. I mean, it's still, I know it's really subjective versus the financial ratios that are, purely number based.
Yeah.
So if you could kind of go over the 5321, I think that would be very helpful for these two companies.
Okay, that's fine. We can. I'm definitely going to do that. There's no question
Okay,
about that.
perfect.
Yeah.
Buckle, I have an overall request before you
Yeah.
start.
Yeah.
I'm not from a financial background.
Neither am I.
Yes,
So a mix two of us. So
I thought you were financial background. Okay.
no.
I'm engineering background. I think it's too many ratios there. For example, SP 500 companies. What are the top three ratios, 3 or 4 ratios you should consider? And
Yeah.
the most of the companies make it or lose it. That will
Right.
be very useful. Because dwelling on 15 ratios for every company is a little very difficult task for guys like me.
No, I agree. Not just like guys like you. It's for everybody. So we'll.
It's all of us. It's all of us.
It's like I thank God that these ratios don't have Greek letters, because I would say it's all Greek to me. So 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 the whole point is there's very few CEOs or any named executive officers. They call them NEOs, CEOs, NEOs. Those types of people, when they reach that level of title in the company, most of them did no capital allocation. There's very few. And so the question is, why is that? Well, they come from operations, right? Or they could come from marketing. And so that's all they know. When they become CEOs, the job is capital allocation and strategy of the business, right? So
Mhm.
so because that is an issue, you're not going to find a lot of companies that right out the bat tells you, hey, this is our strategy. This, when we get cash, this is how we deploy it. We take our first priority is internal growth. Second is maybe some acquisitions. And after that, if we have cash left over, we'll do the following 3 in a specific order. And what are they? They could be we buy back stock. We could reduce debt, and or we could pass dividends, right? So if you hear management saying that right out the bat in earnings call or in annual reports or stuff, you already know you have someone who understands that, right? But most of them won't. So now if you have, like, I think you mentioned already 15 ratios. No, you have to focus only on 3. One you already have, and that is in the SSG, which is return on equity, right?
Mhm.
So that's the one you already have. Now, the others, you might can look at still pre-tax profit, and when you have a pre-tax profit, if something looks weird, you have to like flag it of some sorts to say, I need to kind of dig into that. And what am I referring to? Like outliers. So if you have some outlier that maybe once in 10 years or a couple times in 10 years, it's a little wacky. You have to go dig into that to figure out why. And granted that in the SSG, we kind of toggle them off just so that we are, we can figure out more or less what's the trend line. But for 532, you don't do that at all. You really have to find the reason. So we'll kind of dig into that with these 2 companies. And so I think Ready is really right on the mark that you can't really go through all these ratios for all these companies. It'll drive you crazy. Okay, so that's the intent, which is to have a top 2 or 3 ratios, and then focus on those. And if those top 3 ratios don't meet the requirement, that's it, you're done. You move on to other things. You throw it in the too hard pile or I don't care pile kind of thing, and move on until you find companies that meet those requirements. And then what? The problem is you're going to find these companies that most of them are known. They have great business models, but like quality, it's not cheap. It will never be cheap. It'll maybe reasonable price on the market, kind of takes a hit now and then for the right or wrong reason, or you might have like a recession type of quarters coming through, or you might have a pandemic month, like a pandemic year, but the month it becomes like March of 2020 when prices are down. And then when you have your watch list of all these great companies you've identified with your top 3 ratios, that's the time you you step into your companies that you've identified in the past. Of course, you got to do homework when things are down anyway, just to double check that things are not going wacky in those companies. Does that make you feel a little better already?
Yes, when I saw first time your presentation some time ago,
Yeah.
this is 15-20 ratios. I can understand nuclear science or rocket science, okay, but but the priority is top few, the ratios.
That's correct.
And most of the good companies in, for example, S&P 500,
Yep.
are they meeting those? Okay.
Yep.
And we can as well concentrate on those rather than speculating in the lower end.
Yeah, that makes sense to me. Yeah, absolutely.
Yeah.
Yeah.
That would be nice.
Any other questions or any other concerns? Go ahead.
Oh, I'm sorry. Were you finished, Reddy?
Yeah. In your top priority list, please exclude the ones which are not directly related. Okay. Like ROE is good ratio.
Right.
And I'm not sure pre-tax profit is kind of close relationship ROE, then no, that should be lower priority in my view.
Yeah, on a pre-tax basis, it is related to ROE.
Yeah, so
but
that
you can use a different ratio. You can use net margin if you want, right? But the ones that I propose is ROE, ROIC, and free cash flow margin. So those are the top 3, and that's it.
Okay. Yeah.
Right. So out of those three, ROE is available through SSG. So you don't have to go outside any place just to see ROE because it's already there, right?
Yes, it's available everywhere. Yes.
All right. The other 2, ROIC is not available in SSG. Neither is free cash flow margin, right? So the free cash flow per share is available in SSG, but not the free cash flow margin, which is free cash flow over sales. So those are the 2. You can go to Morningstar or any other website of your choice and then kind of look at those. And once you see those 3 satisfied, then you can say, okay, maybe I need to learn about this company a little better. Go look at other ratios, which are not the top 3, which are the secondary ones, and get a feel to say, okay, this seems to be okay. Maybe a few years here and there, maybe some ratios that don't meet the criteria or whatever that might be, but at least it's satisfactory overall. And then the only concern then is when do you get in? What's the price? Well, usually the price won't be reasonable because great companies with great models, with great management, it's very rare you're going to find cheap prices, right? So then it's a waiting game, and that's where a lot of people have a problem, because if you're too excited and don't wait for the right pricing, once you established one, then you're going to rush into buy it, and so your risk is buying in too high, and you're not going to get your return.
Yeah.
Okay,
thank you. I cannot take any more of your time. Let others ask questions, but I will listen now.
Okay.
Let Anitra. I think Anitra had a question.
Okay.
Well, I kind of a comment and a question. When Bakul came on the line, somebody said, did we answer all your questions? I thought you guys were talking about the questions we were talking about before he came on. And I said, yes. No, I do not understand this. However, Bakul was one of the teachers in Bink, whose class I sat in on. And I was like, oh my goodness, he's teaching all of these people something that he taught our club. And I said to myself, how fortunate we were to get this information, and somebody that he tried to pour this into us before it was going to the rest of Better Investing community. And so I have it. As a matter of fact, I have your recording right in front of me now. And I guess I have the opportunity to go. I haven't gone back yet because I don't get it, but I will get it. But I just wanted to say that I do have the explanation there. I guess my biggest thing is when you say go to the examples, like I'm looking at a return on equity. And even when I did it with Joanne, I didn't know how to go back and get those 10 years and how you put it together and put it on a graph. And like someone was saying, I wish, why don't they have it all spread out? So why do you have to move it over on Morningstar to see it? And so I don't exactly know how you put it together below, especially below the Bob
Wire. Yeah.
Mm-hmm.
Yeah. So I made sure I didn't graph any of those numbers. And the reason why, so I would say 80 to 90% of the people are visual. And once they see numbers, like, you know, it's like pulling hair or teeth rather. But the whole idea was not to give an impression that the graphs have to be drawn. So you have to actually take those numbers from Morningstar or ratios from any other website, and you have to graph it. So that's all additional work. What I wanted to give a experience to people to say, these ratios are all available on Morningstar. You just need a way to get them and know how to interpret them. And that way you do the least amount of work rather than graphing and spending time doing, you know, non-value add stuff. So I don't know if that's the impression I gave or I lost people. So so that was kind of interesting. Anybody else attended?
I did.
I
Yes.
did.
Yeah.
Forgot about
It was
yeah.
great.
So the other thing is, like, I presented this to Portland Group around September, October timeframe, and then later on, a few months later, I had lots of debates with Ron because I was telling Ron, you know, I hate to tell you this, Ron, when I get your email, my email automatically throws something in my Ron folder and I have a look at it. And so, so he said, why do you do that, Bakul? I said, it's because a lot of fluff. I look at a few things. And so then he started asking me, what the hell do you look at? So I told him about my process and I told him what I do. And so he seemed to like it. And that's how we introduced it to your club, basically. So that's the history of this whole thing. So, okay, I think I should get on with it, right?
Yes,
So,
we're grateful.
so what I'm going to do is, I think based on what I was talking to guys, can I minimize the stupid thing? Yeah, I think I can. I got to put it away somewhere. How about here? Okay. You guys can see my screen? Yeah?
Yes.
Yes.
Okay, so I hope we'll make this interactive. I don't want to conduct a monologue like what I was doing in Pink. So I'm going to cover two things real quick before we get to Clearfield and Copart. And then we'll kind of just have like random things, anything else that go on your mind or bothers you, right? So how many financial statements are there in 10K or a typical report that goes to SEC? Can
I
you
don't know.
guys?
4 or 5.
5. Wait.
Income, balance, cash flow,
That's 3.
comprehensive income.
Good. That's 4. What else?
Shareholders equity.
There you go. You got it. It's a total of 5. Most people
Bunch
think
of them.
most people think it's 3. Prior to the 80s, there's only 2, which was income statement, balance sheet. But once we had all those fiascos of Enron, Tyco, WorldCom, and all kinds of fraud, they added cash flow in the 80s, cash flow statement, and then the equity statement kind of started showing up. So basically, a total of 5. So I think that was Isla, right? You were naming them?
Yes.
Mm-hmm. Yes.
Yeah. So those are all that you mentioned, and
Shareholders equity.
the order doesn't really matter. It's just that So, okay, so let me ask this question before I get off this particular slide. When you do an SSG, what is it primarily focused on? Which statement or set
Income
of statements?
statement. Income
Okay.
statement.
Okay, what else?
Cash flow?
A little bit of cash flow because it has cash flow per share. What else? When you evaluate management and there is a ROE, what's the line below ROE in the SSG?
Pre-tax margin. No, debt.
Thank you, debt to capital, right?
Mm-hmm.
Okay. So there are tinklings or little bits of the pieces of balance sheet and cash flow statement, which in the past we didn't have, but obviously we had it in the past in the paper form, which goes a few decades back. And the only thing the only thing we were doing at the time was looking at debt to capital for the most recent quarter, and that's not sufficient. That's not sufficient for looking at trends like if the balance sheet is improving or getting more leverage. But the fact that now we have it for each year, that's perfect. That's even better, right? So it had a few little improvements, so not bad. Okay. There's nothing about comprehensive income and shareholders' equity. You can forget that. So if I really think about the SSG, it's primarily focused on income statement. Would you guys agree?
Yes.
Okay. So now let's see what management does. When management operates a business, cash comes in. What are the different things they can do to deploy capital? Right? You're running a business, cash comes in. What are you going to do with the cash?
Dividends.
Reinvestment.
Dividend, okay, reinvestment. So basically you say, I'm going to grow the business, right? And so what avenues you have to grow the business? What kind of things you would do?
R&D.
Okay, now is R&D in the cash flow statement or is it in income statement?
Cash flow.
No, it's not in cash flow. It's
Not
income.
CapEx?
So let's
Income.
so CapEx. I've got multiple responses. That's good. At least you guys are awake, and I don't want to fall asleep either. So I think starting from the top, management wants to grow the business, so they have two different avenues to go. They could go, let's grow internally, so that will be capital expense, and basically that's just primarily property, plant, equipment. I'm talking of an old economy stock. I'll get to what Ayla was saying. Or they could say, in addition to that, we could do acquisitions. We could do like small tuck-in acquisitions. Or they could be a serial acquirer and they don't invest a lot in property, plant, equipment. They just keep acquiring businesses, right? So those are the two areas of growth. Now, the other three things, which someone mentioned one thing already, but they could buy back stock, right? Suppose they have money for the growth, which is acquisition and or internal growth. Then if the money left over, they could do a few more things like buy back stock. They could issue dividends.
Acquire company. Acquisition.
Hang on for a second. And or they could reduce debt or generate cash from debt. In other words, leverage up the balance sheet for acquisitions. So those are the 5 things they could do. Did I hear Reddy or somebody? You were saying something?
Yeah, acquisition. If they have cash, they can acquire companies, right? Expand.
Right. What happens if they don't have operating cash to acquire business? How would they do it?
Borrow.
They could borrow, or they could raise funds through equity, right? They could have a secondary offering in equity, or they could actually use debt, right? So the financing side of the cash flow statement, the debt could be either reduced or they could increase it if they're making an acquisition. So those are the things. Anyways, so these are the 5 things. So internal growth, I've shown like where you find these things, right? Cash flow statement, It's in the investing section. You look at property, plant, equipment. Sometimes they'll say it's capex. So it depends how the company, what nomenclature the company uses. For acquisitions, it's also in the investing section. And the next three are there in the financing section, which is share buybacks or issuance, dividends, and then the last one is debt reduction or issuance. So far, so good?
So far, so good.
Okay, so
Yeah.
now I'm getting to the ILA kind of world, which is R&D. So the other way to invest in business, suppose, okay, let's forget the piece that I just started. Suppose this company is Google, and they don't, you know, they invest in like their servers and all that stuff. But where is the main? Where do they invest most? If you're talking about Google or a Meta, or it's called Facebook nowadays. So where would they invest if they don't even have
R&D.
inventory? Go ahead, say that again.
R&D.
R&D, and who does the R&D?
Software
The,
engineers.
the people,
Engineers.
the
Software
employees,
engineers. Yeah.
or they could buy the R&D by making acquisitions, right? So we already covered the acquisition part, but they could actually, you know, acquire R&D, right? So
Mhm.
that's where, when you look at R&D, you're talking about people. Okay, now they could also invest in what? Marketing, right? Selling and marketing. And G&A, which is general and administrative, and that's where the people is, right? You got to pay people. So that's the investing through income statement, believe it or not. Most people don't think of it that way, but it's important to kind of have a grasp of that. And finally, on the balance sheet, you could have investments in intangibles, right? Like know-how, or you could have patents, or you could have money tied up in like, they call it working capital accounts. And what the heck are those? Those are receivables, inventory, and payables. Okay. So far, so good?
So far.
Okay, so that's the front matter. I call them bumper slides, which is like background stuff in case, you know, in case we kind of get lost in the weeds somewhere. Okay, so now let's go to Clearfield, right? In Clearfield, we have ROE, wanting ROE to be 15% or greater. In the 10 years, 2 years was satisfied, 8 violated. Is it a pass or fail?
Fail.
Fail. Okay, good. It's already there. You just have to ROIC. I want 10% or better. 5 years satisfied, 5 years violated. Would you pass it or fail it?
And look, one more thing. I
Yeah.
will check one more.
Okay.
Failable.
Fail it.
Okay. Free cash flow to sales. I want 10% better. 2 years satisfied, 8 violated. Pass or fail?
That's a fail. We're done.
That's it. You move on.
We're done.
Right? And then you have a point of view. Always have a point of view. And your point of view would say your ROE, ROIC, and a free cash flow sale criteria not met. Boom. You're done. You move on. Don't waste time. But we're still going to waste time, and I'll tell you why. When companies don't meet requirements, there's a lot to learn of management. Whatever management is doing, your companies that you find, they shouldn't be doing that. So you can dig into 532s. Basically, you have 5 observations in the cash flow statement, right? And I'm going to go through each one. And these are the 5 I made. I don't know what you guys made, but these are the 5 I made. So I identified in some years, like if you look at the first one, the cash flow from operations is less than net income. What that means is money could be tied up in either receivables, payables, or inventory. You guys got that?
Right.
Okay. So if you think of it as a hypothesis, then you have to somehow say, let me go find it. We're going to go find it here. What year was I looking at? Oh, 2013. Okay. So here's 2013. And here's the cash flow statement. Like you got to look at remember I told you working capital accounts, receivables, inventory, and stuff like that. So basically, you look at here and say, in 2012, your inventory was 212, but look at the big jump.
Mm-hmm.
So there's your answer. That's it. Okay, move on next. Maybe I look at 2020. What the heck happened there? So here's your 2020. You notice the cash flow from operations, it suddenly had a
14.
downdraft, but you're comparing the cash flows, operating cash flow to net income. So here's your net income, and here's your operating cash. Well, operating cash is less than net income. Money has drained into something. So was it in receivables? No, it's actually in inventories. It went from 1 million or whatever that
5 million.
thing is to 5. So that's a big jump. So money is, so when a small business is growing, this doesn't mean it's a bad thing. All it means is they have to invest in their inventory. And as a result, when they sell the inventory or install stuff, basically the receivables will also go up. So it's just an observation. It's not a red flag or anything. It doesn't mean it's a bad thing. Okay. So what's so good?
Good.
Yes.
Yes.
Okay. Okay. So that's that statement. Now, just to kind of confirm, or like, you know, you have some other information in these statements that also will tell you that they're putting money in inventory. So we already looked at 2020. Let's look at 2021. So here's 2021. So you remember you saw the 5, and suddenly it's gone to 13, right? Okay.
It's going up.
Now, if inventory is piling up in a business and the sales are not coming in fast enough, or the demand slows down, what's going to happen? Tell me. Either the sales go down or demand goes down, or the sales and demand is there, but they made more inventory than the demand What's going to happen?
No,
Increase
money's not
inventory.
coming in.
You have cash tied up. You've got cash tied up in inventory, right?
Yeah.
Okay, so same thing like 2022. So you got those 3 years, just kind of going through it. And so here's, oh, this time we're looking at, again, see that 5, we saw the 13, suddenly it's 43.
Oh my gosh.
So they're putting a lot of, and that's okay for a growing business, a small business, right? Okay, so now, so those are the 2 statements. And now let's look at this one. In 2018, 2022, we had acquisition years. So let's go look at that. So here's the section, here's the section in investing activities, business acquisition, boom, there you go. Right? Now think about it this way. Here's what I would think about. I would say, here's a business from operating cash. They brought in 4, but they're investing 10. So they've got to, they have to get that money from someplace, right?
Yeah.
So you have to think along those lines. In the meantime, let's look at this one here, 2022. So here's the business acquisition, 16,
16.
right?
Yeah.
All right, and we keep going. So now let's look at 2023 Q1. Remember, the fiscal year ends in September, so it's October, November, December, right? So that's the December quarter basically, but it's 2023 Q1. Even though it's the calendar 2022, but it's fiscal 2023 Q1. Just be aware. That's why I put the fiscal year in here. Okay, so let's look at that. Here they've issued stock.
They sure did.
But what did they do? They repay long-term debt.
Pay down debt.
Yeah. Okay. So again, it's the same observation, but it's a separate line. I've already showed you that, but I'm pointing to the same spot anyway. Right? They issued debt. Excuse me. They issued shares and they paid down debt. Did the market like this? Yes or no?
No.
Why?
No.
Why?
Because they use their money. I don't know.
They devalued their shares.
Whose shares?
Share
Prior
owner.
shares. The
Shareholders here?
shareholders' value was brought down by the issuing of new shares.
Right. So shareholders, you are saying the existing shareholders, right?
The existing, right?
Yeah. Remember I talked
Whoever
to
owned
you.
shares before December,
Yeah,
whatever it was
exactly.
worth on December 5th, it was worth significantly less on December 7th.
Right. Remember I gave you an example. We wind up in Jay's house. She invites 4 people. We order pizza. We split it in 4, and we got 25% each. Suddenly she gets an uninvited guest or surprise guest. Now we got 5 people. So now we split it 20% each. So basically your existing share that you thought was 25% now is 20%. So you went from 25 to 20. So that's your share dilution. Got that?
Yes.
Yep.
Okay. All right. So now we look at balance sheet. Remember, money is going into inventories from cash, so you might want to check the balance sheet, what's going on with stuff over there. So let's go in 2021. You see how the money is tied up in inventories from 14 to 27. So that makes sense because you're already seeing it in the cash flow. You're expecting that. It's not like it's a surprise. Okay, then look at 2022. We went from 27 to 82.
Oh, wow.
Okay. So as long as the sales and all this stuff come in, that's fine. What's the other issue this company might have, or any technology company building up inventory have?
Obsolete inventory.
Thank you. You have obsolescence. When you have obsolescence, what happens?
Doesn't sell.
You have to write it off.
Doesn't sell, you have to write it off, right?
Yeah.
Junk. Okay. So now with acquisitions, you also have to look at like, you know, how expensive, what's the premium the company is paying to make acquisitions, and that premium is tied in the goodwill account on the balance sheet. So we kind of go track that. Remember, I said they made 2 acquisitions, right? 2018 and 2022. So here's the 2018, and here's the 2022. So let's go check that out. So now you got to look at the balance sheet and say, okay, here's the goodwill. So we went 2.5 to 4.7. See, that's your money tied up basically. They're overpaying. Most acquisitions are, you know, there's a premium, so it's not kind of weird about this company. And so now here's 2022, and from 4.7 to 6.4, right? So the way to track this is not in my financial ratios, but the way you can track it over time, especially if it's a serial acquirer, is you say goodwill to assets. When that starts going over 25, over 30%, you know, it's a loss case. Get the heck out, because sooner or later they're going to write it off. Okay. All right. So now I think this one we've already seen right here, right? But we're going to look at it again. Took on debt in 2022. So you notice the long-term debt on the liability side of the balance sheet, there was nothing before. Suddenly it's 18.6. That's fine. If you make acquisitions, well, guess what? You need to raise cash. And then when they paid it off from 18, it's gone down, right?
Yep.
Is it all making logical sense from cash flow and balance sheet?
Yes.
Yes, no, am I lost?
No.
Okay. All right, so now here's the income statement. That's the only 2 things. So single digit pre-tax profit years, boom. Not that it's bad, it's just that it's single digit. It's like it needs to kind of start tracking to get better, right? So here you go, it's 7, 8. So these were the even years earlier, but even in 2015, it's kind of low. You want some double digit kind of, you know, instead of 7, you start hopefully get to 10, but it's not happening. Okay, so here's 2020, right? You would expect things coming down. It's not. So this had to do with the diluted share count, right? So it went from 13 to 15 because why? They actually, what they did was his diluted share, it went from 12 to 13, right? And then you keep going to the latest quarter, We are at 15. So if you look at this trend, 13, 14, 13, boom, suddenly 15. That's because they raised funds in the secondary market in equity. The market didn't like it, and the thing crashed or basically came down. So that's your 532, but you still have to have a point of view. It doesn't have to be sophisticated. It's a one-liner. Everything. Notice everything is one line in this 532. It never goes over two lines. That's precisely, you have to laser point your thinking and specify exactly what you're observing. We're not writing a thesis. We're not writing a paragraph. It should not be two lines. This was my beef with Ron. He would write paragraphs, and I threw it away. I just, Ron, this is trash. Rewrite and redo it. And so for 1532, we'd go for 3 or 4 days until I forced him to do this kind of thing. So now you can say, okay, do I feel good about this? Well, I don't know. It's a small company. There's a lot of variability. It doesn't mean it's a bad company. But if I did not do this 532, I could have just stopped where? Oh, I could have stopped right there, right? And move on.
Yep.
But I learned a lot by just doing this exercise. Whether you choose to do it or not, it's okay, right? Okay, so let's. Any questions about Clearfield up to now?
Okay,
So would
this is
you?
Joanne. I still have some questions about the observations because you said we're not saying it's good or bad. We're making observations.
Right.
So how is that an asset? I mean, the first three are that we looked at on your 10 ratios. That's the management, right? Is that a management assessment on those first three on the 10 financial ratios?
Yeah. So is
Okay.
this. This is also management assessment.
Okay, this is management also, but does this make it more clear about why those first three are not good?
Absolutely.
So this is like a more specific or defined view of why those first three, it doesn't pass the first three.
That's
Is that
correct.
correct?
Yeah,
Okay.
absolutely. Yeah. Okay. Anybody else before we go to Copart?
Oh, can I?
Would you? Go ahead, Pierre.
Oh, can I ask a question? When you first looked at the cash flow statement,
Yes.
and you were going into inventory, everything was kind of within brackets. Everything were negative numbers.
Yes.
What's the relationship between that and cash flow? Like it's a cost to the
Yes,
company?
absolutely. It's cash going into inventory, so they're building inventory.
So they note it as a negative number.
Yeah, cash going out is negative. Cash coming in is positive. That's it. That's what happened on the cash flow statement.
Okay, but it's our inventory, right? Isn't that considered an asset?
It is, but the asset is shown on the balance sheet. Cash going out, so okay, you have a business, right? You could have raw materials, or you could source the inventory, and you put some value add. So in order to get the inventory, what do, Piero?
Yeah, you just pay the raw material and
Right,
build
so
your
that's cash going
product.
out, right?
Yeah.
Okay.
So cash goes out, you build your material, your item that you're going to sell, and you put it in your store, your warehouse.
Right, and so
So that
now it's a finished product. A finished good becomes on the balance sheet as inventory.
Yeah. So it's an investment on our part, which took money in order to create.
That's correct.
So it's a cash drain for us.
Yes. A lot of times you don't even buy things on cash. You buy in credit, so your payables will go up because you owe money to your supplies, right?
Yeah.
So it all has to balance out, basically.
Yeah. Okay.
So it seems like, I'm sorry, this is Anitra. So it seems like when it went up to $130 in December.
Okay.
And people had it the year before, December of 21, it was like $50, $60. So it went up over 100%. So it seems like the seasoned investors, those who have been there, who saw what they were doing with their money, because as investors, we're letting them use our money to make these moves. And if you don't like, if you know what you're looking at and you don't like what they're doing, you pull out. So that seems like all of them started pulling out, which made it go down. And of course, the new people or novices or whomever started buying in because they thought it was going to go back up again without doing the research.
Well, it's not necessarily without doing research. The smart money is always ahead of the, small peons like me. So, so who's looking after me is me. So, and then at the end of each quarter, assuming I have a position like that and it doesn't do well and I'm not wide awake to get out if I already had that position, then I have something called a cognitive dissonance. So what does that mean? It's a fancy word of saying I have two conflicting thoughts at the same time. And what are the thoughts? I'm standing in front of the mirror talking to myself about my portfolio, and the other side of the mirror is a portfolio manager, namely me, and me as a business analyst, and I'm saying, this didn't work out. And the portfolio manager say, were you sleeping at the wheel? What the hell's wrong with you? So it's like a come to Jesus talk with yourself at the end of each quarter. So I want to prevent that, right? So,
Okay.
and you can't prevent all of them. You might have some good positions that the management do some weird stuff, and you can't avoid them. You
Okay,
gotta
and
take
I
with
want
the
to
good with the
correct.
bad.
I want to correct myself. It was November 25th of 22 that it went up to over about 130 and some change. Okay, thank you.
Sure. Was that Anitra?
Yes.
Okay. Anybody else before we move on to Copart?
Would you put the stock in your watch list, or you just
No,
totally forget it? No.
no. I
So
wouldn't.
based on your conclusion, you will not.
No, I
Even
wouldn't.
if 2022. Okay.
Yeah.
Buckle, I have a very quick question. I've been listening.
Yes.
Is building inventory is wrong all the time, or I think there are some advantages in a few situations, right?
Yeah. So what are the situations?
I think if they are increasing demand and forecasting the building inventory to meet the future nearby demand is very good strategy.
No, of course. It's not like it's a bad strategy. It's just that they have to invest in inventory, to be ready for the demand that they can't keep up. All the competitors in the entire industry can't keep up, right? Because everybody wants to go whatever, and so the network, whatever the equipment they're producing is in need, and if they are short, then the customers will go to the competitors. So you have to be very careful. The only challenge with small companies is that they're not stable enough, and their volatility is very high, right? And so the question is, do you have the emotional makeup? Do investors have emotional makeup to withstand all the volatility that's such that, assuming that strategy works, that you are ready to accept that strategy, that could potentially go in either direction, right? It could be zooming up, or maybe the strategy doesn't work and the thing kind of comes crashing down, right?
Ready? Also, they're not really investing in inventories. They were investing in having a lot of inventory during 20, 21, and 22 because they were getting bigger orders.
Oh, okay.
Now they're still making that. They're still making those orders and they have the inventory, but they have the inventory because their customers are not buying it.
Okay, so now you're going to have a problem, right? Because it's going to
Yeah,
reflect
so
in
it's
the
not like they're
ratios.
really investing in inventories. The inventory is just sitting there. They keep making more because that's what they're supposed to do, but their customers are not buying it. So there's more of it piling up and piling up and piling up.
Yeah. So if that's the case, what happens, it'll reflect in the ROE, ROIC, and the free cash flow margin, the top three. It will start trending down on a quarterly basis.
And if you look at the current, those current ratios right now, they're still elevated from what they were, say, in 20, but they're not as elevated as they were in 22.
Okay, yeah, makes sense.
I got a last question, because when we did Amazon, it was 89, and Ron did these numbers the same way you did or similar, and he said, no, this is not good. And we were all seemingly confused because we thought it's going to go back up. It says it's gotten low, it's going to go back up. And he said it didn't have the substantial numbers to make it a good buy. So it did go back up, but it didn't go back up because the numbers were good. It went back up because it's Amazon. Of course, we had no comparison. So
Yeah, so
did it make it? Does it make Amazon a good buy, or it's still not a good buy because it's something you got to watch all the time because it doesn't have a good foundation, or what?
no, Amazon is a different animal because
Okay.
the crown jewel under the hood is called AWS, which is cloud computing. And so what they do is that's the biggest profit maker, right? But the way they were funded to get to that point is from the retail side. The retail has tremendous scale, but it's not a profit maker. So the retail side of the business actually loses money, but it generates sufficient cash to kind of do the R&D kind of work, allowing them the AWS kind of business becoming very profitable over time. So it's quite a different business model to understand, right? And so you know, I haven't done a 532 or any other stuff for Amazon, but great companies will always kind of, you know, even if the market doesn't get the pricing right, eventually it comes back up relative to its cash flow and earnings generation, right? And so you have to kind of figure out where is it in that cycle.
Actually, funny enough, Amazon's web service was down last week. All the echoes were
Yeah.
not working if you have it.
Okay,
Well,
well,
also they're saying in their most recent report that their percentage of cloud computing is dipping because they have more competitors now.
of course, there's Google, there's IBM, there's Microsoft.
Microsoft is
Microsoft,
biggest, yeah.
you know, SAP, everybody's got, you know,
Mhm.
everybody's
Some
got
form
a
of
cloud
cloud.
service now. So
Mhm.
for a while there was no other cloud service. Everybody had to go to Amazon. But
Right.
now, you know, not so much.
So you brought up a very interesting point. When you have a high margin business and nobody else is doing it, people will start coming into that business, and your profit margins will start trending down towards the industry average, right? So that's what typically would happen,
Mm-hmm.
whether it's in Amazon's business or any other business, right? Okay, did we have enough of Clearfield? You want to move on, or I could go on
Yeah,
until the cows come for, you know, come home. So
this is good. We can move
okay,
on.
Yeah.
all
Yeah.
right.
So
So
Copart.
here's our Copart friend. It's quite a different
Business.
company. So here's ROE. Here's ROIC. His free cash flow margin. Pass or fail. You have the answer.
Yep,
Pass.
Buy it.
Pass. Okay. So far so good. So we can still look at the others. Now you notice it's not a bed of roses or a walk in the park kind of thing. There are some areas, like look at capex to sales. For 3 years they didn't make it. For 7 years, or excuse me, for 7 years they didn't make it. 3 years it's satisfied. Free cash flow net income, 9 years didn't
Not
make
doing
it.
well.
1 year it was satisfied. But for the most part, if you just look at these top 3, it's a go, right?
Yep. Mm-hmm.
Okay.
Mhm.
The
Yep.
only problem is that you don't know where it's in its pricing cycle relative to its earnings, right? So if you think the PE is too high, you might have to wait. Or if the PE is just about right, that you might start nibbling into, take an initial position, and then slowly accumulate it. We don't know where it's in its cycle, right? Because you remember these ratios are not looking at prices, right? They're just looking at fundamentals. Okay, and the point of view is really simple, right? The top 3 ratios are met. By the way, ready? Does this help you? Where you only look at top 3, and if it makes it, it's a go. If it doesn't make it, well, too
Move
bad.
on.
What do you think, ready?
Yeah. This slide is useful. The first we evaluate and compare a few of them and
Right.
look at the top three ratios. The
Right.
ones who don't meet, just throw them out right away and go for the next candidate comparison.
There you go. Yeah, there you go. Because you know, a lot of times you wind up wasting time with looking at stuff, and it just gets frustrating, you know. And so, okay, so are we ready for the 532 for this one?
Yes.
Okay, so here's this first one. Cash flow from operation greater than net income. Is that a good sign? Yes, no?
Yeah.
That's good.
Yes.
Buckle, maybe I missed something you probably did go through. What does 532 represent?
Okay, so basically this 532 is like you make 5 observations from the cash flow statement, 3 observations from balance sheet, and 2 from the income statement.
Okay, I didn't see the slide. Any
Okay.
on the slide. Okay. Yeah.
All right, so it's just in other words, how much homework you have to do. That's what it is. Now, companies whose ratios look good, they're all not perfect. Okay, so you got to be aware of that. So here's this company. They had write-offs for like some of these different years. So let's go check them out. What the hell happened there? 2014. Right. So if you look at this one here, they had an impairment.
Oh.
Right. In other words, hey, they were trying to do something, didn't work out. They had to write off a loss or some weird stuff going on. So if you dig into it, and if you go like, you know, go the rabbit hole, find what the heck that was. Basically, what happened is they were installing SAP software or something. It didn't work out, so they just shut off the project. Basically, somewhere in there, that they were saying. Okay, next one. Same thing here. Impairment of long asset. Well, see, another year, some weird stuff happened. But they have to divulge all that information. It's material, so then they say it on the financials. No big deal. At least you get to be aware that even though the ratios look good, they still had some issues, right? So okay, so you kind of identify those. Keep going. In 2015, they issued debt. Okay. So so you look at the financing side of the cash flow statement, which is the third section, and sure enough, proceeds from issuance of long-term debt, boom, 698. Now when debt is issued, is the balance sheet improving or is it getting more leveraged?
More leverage.
More
Okay.
leverage.
Yeah, right. Okay. So now in 2022, fiscal 2022, they pay down debt. Let's go check that out. Where do you find that? Again, in the financing section, principal payment, long-term debt, boom. Now, if they do that, is the balance sheet improving or is it deteriorating?
Improving.
Should be improving.
Yeah. So you guys are smarter than the average bear in the woods. I don't know why I'm doing this. Okay. Now check this out. Share buybacks, right? One of the capital allocation thing, buybacks. 2015, they did buybacks. Let's see what the heck. Again, in the financing section, repurchase common stock. See, 572, 237, boom, big buybacks. Okay, good. 2016. So 2016, and here repurchase. Here you go. From 237 to 457. You guys see that?
Yes.
Okay, 2019.
Impairment, repurchase.
Repurchase common stock, 364. Remember the 2 bumper slides I had? Those 5 things they could do? Well, there you go. This is one of those kind of types. All right. Now let's look at the balance sheet. We want 3 observations there. Buildup of cash. Okay, so let's go double check that. So this is more recent quarters. That's like the 10Q. Okay, so now look at the cash position. They went from 1.3 to 2.1. What does that do to the ratios? Anybody? What happens?
Increases them.
Actually goes down. So let's
Really?
think about let's think let's think about that a little bit. Return on assets, right? It's net income over assets. Net income over assets. If your assets increase in the denominator with the same level of net income, is the ratio going up or down?
Yeah.
Going
Down.
Right.
Right,
So a
down.
down ratio doesn't necessarily mean it's bad. It just means you got to figure out why. We've already figured out why the cash position goes up, or in this case, the cash position has gone up. So if you see a trending thing going down, it's not like a red flag. You just figure out why. If it makes sense and the balance sheet improves or it's stable, that's fine. If it goes down because of the wrong reason, where they did some weird stuff, then you know it's a red flag. But in this case, it's not. So cash increasing on the balance sheet, it just means that, oh, at some point they have to deploy that cash, and where are they deploying it is one of those 5 things, right? To grow the business, they could invest in their infrastructure, or they have to make acquisitions, or they have to hire more people. If it's a knowledge-based company and there's not much inventory, if it's like a Google, they have to hire more people, or they have to invest in R&D, which is the income statement side. But the bottom line is they have to start making use of the cash and deploy it. Because if they don't, then your return on assets, your ROE, your ROIC, those kind of things will start trending down, right? It's not a bad thing. It's just that you need to be aware of that. All right. So that's that. Long-term debt decreased significantly from 398 million to 2 million. So let's go check that out in 2022. So it's going to the balance sheet. So here's a balance sheet, 2022, 2021. Remember, fiscal year is July. And here we go. You went from 397 million to roughly 2 million, right?
That's a lot.
Yeah, I mean, so now is the balance sheet improving or is it deteriorating?
Improving.
Improving.
There you go.
I have a question. You already mentioned the debt payment in cash flow. Why do you want to check again in balance sheet?
Yeah, so in the cash flow, it's money going in and out between a day, starting date and ending date, right? So beginning of period, end of period. The balance sheet is a snapshot. So think about it this way. Think about it this way, Jay. So suppose you're a householder and you have a mortgage, right? And your mortgage is like, I don't know, your remaining balance is 100,000, and you paid off 98,000. So the cash came out of your in either investments that you sold, or you might have the cash lying around in your bank account. You took that $98,000. You cut a check. When you cut the check, what happens? The balance went down, right?
Yes.
Okay. But at the same time, the balance of your mortgage went from 100,000 to 2,000.
2,000.
So that's a balance sheet item,
Mm.
right? It's a snapshot in time versus the cash flow statement and income statement, a flow of monies and cash, whereas the balance sheet is a snapshot
over a period of time.
right?
I see, but then what I'm trying to say is you already know they are paying off debt. Should I focus on something else on balance sheet?
Yeah, you still have to figure out if the balance is reducing significantly or not, right?
Oh, okay.
Yeah.
Gotcha.
So that example would be more like this, Jay, is like instead of paying 98,000, if you have 100,000 balance on a mortgage and now you paid 50,000, right? So your debt to capital in the first instance would be different from the debt to capital in the second instance because the balances are different, right?
Right.
Okay.
If we see a cash flow statement saying that money went out,
Yes.
the value of that money should show up on the balance sheet.
Yeah, of course. Yeah, absolutely.
If it doesn't, then we can assume they're using that money to do something that's not exactly above board.
Yeah, so here you go, Piero. Here's the payment of long-term debt, right?
Yeah.
Mhm.
There you go. So now you would expect that on the balance sheet there's a reduction in the amount.
Yeah.
And that's what
Okay.
we looked at. So that's what this guy is saying. It's going from something to something.
Mhm.
So timing of cash flows will be different. You won't see an exact number of like, reduced cash went out, but you'll see that it's trending down. It's all like, I call it accounting stupid stuff like accrual and timing of cash. And I don't even care about all that's all nitpicking, but the point is you can see the trend. That's the idea. Okay.
But Bakul, can I ask a question? This is
Yeah.
Joanne. Um,
Yeah.
So I see you looking at 2014. Is it like the last 10 years you're looking at of
Yes.
all the statements? So you're
Yes.
looking at all the cash flow statements for the last 10 years, all the balance sheets for the last 10 years.
Yes.
And then are you looking,
I
and then you're
think,
looking,
Yes, it's exhausting.
and
no,
then are
I
you
think what
looking,
you look at was looking at a financial statement. I believe if you go to the previous one, the first 3 years did not do well or something. Is that what you focused on?
No, I mean,
I
you
think
can look at
14, 17, 22.
No,
you
no.
can look at all the okay. So one thing you can do is the following. I'll tell you what you can do. You see this you see the set of ratios.
Uh-huh.
yeah,
Mhm.
Okay, so you can say, I seem to be okay with ROA and ROIC, but something happened in one of the years in the 10-year period. There was a violation of a free cash flow margin not meeting the 10% watermark. So then you say, which year it is? Let me see what's happening. So that's
oh,
where
okay,
your insight might come in, right? And so
okay.
you can do that with the rest.
So you just pinpoint certain years. Okay,
And some of those could be significant. Some of those could be like a nothing burger, doesn't mean anything, so you let it go, stuff like
okay,
that. But it does require work. I know you started
okay,
saying 2014. Oh yeah, it does take work. So
okay. And then with the balance sheet, you're looking at the quarters also, or just, because usually I think we're just looking at the annual reports.
right,
But
so the annual reports do have those statements. So you do the
okay, so
good
so
annuals.
most recent quarters, then you're not going back and looking at 10 years of quarters.
I'm not looking at 10 years. I'm looking at quarters going forward.
Okay, quarters. Okay, great. Thank you.
So you notice this was like year-end July.
Mm-hmm.
And I knew that question is going to come up. So everything up to here has been annual, but you look at, I
Okay.
included one quarter,
Okay.
right? So that's more recent quarter, right? Not
Mm-hmm.
historical quarters, but I'm looking at quarters going out, more recent quarters.
Okay. Okay.
Because 2022, what happened is their fiscal year ended in July.
Mm-hmm.
So if I stop at July, a few quarters have rolled in, so I need to know what the heck happened in those quarters. And so one of the observation was, oh, they had a cash buildup. Interesting. Not a bad sign. So that's actually a good thing.
Yeah.
Even though the return on assets will go slightly trending down, but it doesn't matter because that's a good thing.
Okay.
All right.
Quick question. Significant share buybacks are always good?
Yeah, of course, because your share count goes down, right?
It's like that if you were
Something
having,
else.
if you were,
me and
it's like
Jay.
if you were,
Go ahead.
if 4 people were having pizza and each gets 25% and then one person leaves, then the 3 remaining people get more.
Right. So one person
Okay.
doesn't show up. It's a no-show. So what
Yeah.
happens is
Yeah.
Jay was saying everybody's going to get 25%, but then one person flakes out on us or on Jay and say, okay, there's only 3 people. Now your 25% went to 33%, right?
Got it.
Yeah.
Yep.
Okay, so this is the weird stuff when I was asking how many financial statements are there. You noticed it says, oh, on the balance sheet, there's some comprehensive law. What the hell is that?
Oh,
So you go
God.
dig into that. right? And say, oh, okay, well, there's an equity portion here, but somehow something went from 100 to 169. That's the time you start looking at, now I got to kind of go way back. So the way I'm going to go way back is this way.
Way back machine.
Not there actually, sorry. I'm going to go here. Nope, here. Okay, you notice this guy here?
Mm-hmm.
So that's why you got to look at these kind of things to see where these line items coming from. So you dig into that and say, okay, they may have created some loss somewhere along the way on the basis of income, and because of that, I'm observing that it's booked right here. Right here. Suddenly it went from 101 to 169. So all it means is that there's a reduction in the equity account, which is the owners of the business. So you just have to be aware of it, that not a lot of that stuff occurs over time. That's it. All right, so now I'm going to go to the income statement. So from 2016 to 2017, I observed that the net income went up, right? So, you know, it's just something to be aware of, to say, okay, well, looks like this guy's, whatever the heck these guys are doing, the strategy appears to be working. So they went from 219 to 270 and suddenly, boom, 394. So these guys are doing something in their business that's causing it to be good over time, right? That's all it is. And then a weird one is, oh, but at the same time in 2022, they had a write-off. They had some weird stuff going on, but it's not written as a write-off. It's written as something else. What the hell is that? It's a loss on extinguishing debt. Aha.
Ah.
So
What does that mean?
it means that they might have paid off something. Okay, so let me give you an example, Jay. I don't know the details of this debt, but so you buy a mortgage on a house, and you don't look at all the covenants of your mortgage, but it says there's a weird situation in here that you haven't noticed. And so now, let's say you paid interest rates of 5%, and suddenly it's 2 because the interest rates are downtrending. And then you say, you know what, I want to refinance this damn thing because my cost of like money going out, my mortgage payment is going to go down if I'm going from 5 to 2. So you kind of go through escrow, do all that stuff. Suddenly you check your paperwork and you have to sign it, and you suddenly see that like $3,000. Where the hell that's coming from? I have to
Extra
pay
cost.
that. So where do you think that's coming from?
The fees.
Closing costs?
What fee? They all fees. What fee?
Refinance fees. I don't know.
It's not that fee. There's a
Closing
special
costs?
stipulation in the debt covenant that says that if you prepay the mortgage and before its regular schedule,
You got to give them
gonna
some
pay a
money back.
prepayment penalty.
Oh,
Give them
right.
money back,
Oh,
right? So when
crap.
you
I
prepay
don't remember
stuff,
if I
they
paid
make
that.
you pay
Oh
for
my
that.
gosh.
So now you got to
Oh.
make sure that when you do refinance, or forget the refinance,
Mm.
when you make any loan, whether it's mortgage or car loan, that you ask the loan officer, does this have a prepayment payment penalty? And they'll say no, it's not. I said, show me where it is. Can you tell me where it is, please? Because it's so small. By the way, I'm a senior or whatever. You give some weird excuse, and then you let them literally show it to you in the covenants. That where does it say that if the mortgage is paid off ahead of time, prepaid, that there's no fee for it. So that's how you protect yourself. So these guys must have done something like that. But that's normal stuff. It doesn't mean it's bad. Okay, this is normal business.
Where do you go to find that in the
covenants?
10K?
No, it's
Okay.
not in 10K. It won't be in 10K. It won't be 8K. No, the K business. It's the original. Debt documents and covenants that they had. You got to go dig into that. So that's called like a term sheet, and a term sheet will have all the nitty-gritty stuff. If you want to go that far, good luck, but I wouldn't do that. Are we all good?
Yes.
Okay, so
I also remember you mentioned if they have buyback shares, you always want to check share count goes down.
absolutely, yeah, sure.
But what if it didn't do it?
Then those buybacks are useless, because what they're doing is they're paying their employees by shares, by equity, And if the count doesn't go down, kind of stays more or less the same, they're basically preventing dilution, right? So, you know, when they pay employees by equity, in other words, shares, then they have to issue shares. When they issue shares, it dilutes the long-term shareholders and existing shareholders, and therefore they want to prevent that. To prevent that, they have to buy back shares enough so that the count doesn't go up.
Balancing act.
Does that make sense?
I'm processing because for Copart, the share count went down except 2022. It went
Yeah.
up. I try to understand, okay, what does that mean? What happened? Like,
Yeah, so you have to go dig into it to see what they did. Did they, you know, what you have to do is you have to go look at the financial notes in the 10K where they discuss, like, you know, do they give you a reason why they did the buybacks and what happened to the share count?
I don't, I need to look at the detailed notes, but I just look at the trend, what I haven't noticed.
Yeah, sure.
2022, yeah.
Yeah, you got to look at the trend anyway. So the point of view is simple. It's an organic grower, right? But it had some write-offs in 3 years. Right? The point of view is the only opinion on this thing. Everything else is observation. It's facts regurgitated. But it does take time to understand where those facts are coming from based on outliers or something that looks weird or doesn't make sense to you. You write them down. Single line statements, identified in a way where you can track it, where you got it from, like I was showing you. So you can, if you're an analyst or a stock watcher that you already own, you know, this thing, you can do stock watching like this as well. But the only opinion you have is one point of view, and that's it. Okay, you guys have any other questions? Anything else on your mind?
I don't have a question, but I do have a
She
comment.
looks like us.
I think
My comment is that sometimes people purchase, like me, I purchased something that didn't fit these parameters. Not, I'm sorry, and I knew that it didn't, but sometimes we make a purchase because of the fear of missing out, you know, and that's what I did.
FOMO. Right. A lot of people, that's a normal thing. Oh crap, I missed Amazon. Oh crap, I missed I don't know, Google. But guess what? There's more opportunities coming down the road. So you don't have to keep regretting and have FOMO and behave really bad. If you behave really bad, then you're not going to get a return. So you have to think of it in a different way, right?
Yes. Thank you.
Yes. Everybody suffers for fear of missing out. We're not
Buckle,
that.
Buckle, I have a quick question, Buckle.
Yes.
It looks like you have so much stuff. Did you write a book on this, or I don't know, any detailed write-up?
No, actually, I went to a special school. It's called the School of Hard Knocks.
Oh, oh. What we're trying to avoid, that one?
Yeah, it's better to learn from somebody else's experience, right? So
with some training, I can do that too, but then you are living far away, okay?
yeah, well, the thing is, like, you know, this comes over time as you practice understanding a business model, ratios. It comes over time, and as you get better, you'll see that you are able to have more confidence in your ability to deploy your hard-earned savings because you don't want to lose it, right? So step one is capital preservation, right? Avoiding loss. That's the main thing. If you can avoid losses in everything you do, chances are returns will come in. They may not come in 6 months, a year, but when they come in, they'll come in big, right? And it's very hard to do because why? As you try to understand the concepts of a business model with ratios and see cash going in and out, or the balance sheet or income statement, it gets frustrating because cash is building up and you keep thinking, oh, I got to deploy cash, I got to move this cash move. But if you do it too quick, then you have that FOMO kind of situation, right? And so it does take a while to kind of get things in order.
Yeah, but those those parameters we described are interrelated. So one is going up and one is going down, maybe good sometimes, but yeah.
Yeah, so if you look at ROE, ROIC, and free cash flow margin, the top three, if those check out good and they are consistent in some range, chances are you found a good company. Your only problem is the price.
So Copart is 7 out of 10. We're looking for 8 out of 10
What are you referring to? 7 out of 10?
because the first three, the top part is the first three. That was a pass, so that was above the barbed wire. Below the barbed wire, you have 7 other categories, and the 4 of those were a pass, and 3 of those were a fail.
That's correct.
So are we looking for, I remember somewhere someone said, I thought they said 8 out of 10 or something like that. That's my question.
Oh, I see. No, it's not that way. Look at gross margin. There's 10 fails, right?
Yes.
Okay.
Yeah. Oh, yeah. Okay, that's bad.
Okay. Let's get to that. Let's kind of laser focus on that. A company like Copart, its gross margin can be over 50%. Right? Here's why. Well, let's see if I can. Let me see if I can. Oh, I got so many tabs up, right? Whoa, close out some of these puppies. Okay, so if you look at Copart, I'm gone well over my time. I'm surprised you guys still around.
Russell, when you're searching your screens, those ratios that you listed should be dependent on the type of industry. They cannot be same for every type of industry, right?
Precisely, and therefore, if you look at, especially with margins, like you look at this thing, right? You look at Copart. Tell me what are the gross margin characteristic of this business. If you go left to right, what do you see?
Steady.
Steady,
Roughly
pretty
ranging in the 40%
good. 40,
range, right?
yeah.
Going, yeah.
So look
Yes.
at all this, right? It looks good, but it's in the 40% range. So if you come back here, and if it fails because I have a very tight threshold, then I shouldn't worry about it.
Yeah.
Mhm.
Yeah.
Precisely
So
what
can
Reddy
you
said. It depends
explain
on
why you're using 50%?
because I'm a crazy nutcase. No, it's it's
Oh,
because I wanted to focus on companies that are knowledge based, in that they don't have a lot of inventory. In other words, they don't depend on a lot of inventory. So if it's a knowledge
not
based,
industrial type companies.
like the old economy industrial type. So when I came
Right.
up with my ratios, like if you look at a Google or a Microsoft, I mean we should do it. What the heck? Why do I talk about
Yeah,
it?
what's there?
So now if you look at a knowledge-based company that they don't make money on inventory, they make money on people and R&D. You now look at their gross margin and see what you get, right? You'll see that's the reason why. Okay, what do you see?
Wow. Yes.
Yeah. Yeah.
So I want a good start on the top, right? And when I get a good start on the top, hopefully they're managing people properly, so the operating margins, well, okay, look, they're all over 15%. At the same time, the net margin, it should fall to the bottom because I'm risking my money and giving it to someone in the hopes that it will be good in the future, in 5 years, 10 years. So the net margin is well above 10%, as you guys can see. Well, something will happen in 2017, but it's still good. And then if you keep going, so, oh, they're all above 10. Aha. Guess what? This is something I can live with. Well, guess what? I've never owned Google, so there's your FOMO coming, right? But the point is, I recognize that, oh, I didn't understand the business model of this company, but now in the future, if I see a high gross margin business, at least I want to know, oh, are these in check? Yes, they are. Then let me look at the cash flow. If I want the free cash flow margin to be 10% or better, well, wow,
Yeah.
there's cash coming to the bottom. I like this. There you go.
Okay.
That makes me feel good, right? So that's the whole idea. So just like Reddy said, you can't. These margins are dependent on the industry, and also it's dependent on the management in that industry if they manage their business properly, right?
Yep.
So that's the idea. So if you have a fail like that, like this, you shouldn't be worried about it.
Yep.
Even though it has a fail on the top, look at this operating margin, 10 pass. That margin that already tells you it's the Copart is in an industry that is not over 50% margin, but it's telling you that the operating and net margins are strong. That's why they're passed in that direction. There you go.
So it's not a failure as a company, it's a failure based on your requirements.
That's correct.
Exactly. Okay. All right.
I want to repeat what I said, Buckle. The threshold that you listed should be dependent on the industry and type of industry.
That's correct.
Yeah.
Especially if you're talking of margins. But there's no exceptions for ROE, ROIC, and free cash flow because that's more capital allocation, right?
So, but
So
so
next,
what?
so next time when you come to work with us, you're going to show us maybe when you would change these numbers? Like if it's banking
You will not
No,
change
or
these
if it's
numbers.
something else?
there's
Hint,
nothing
No,
to
hint.
but
change.
EC just said if it's the industry, for a different industry, these numbers may be different. So it would be, would it be like banking or, you know, something that's different than this
These
industry?
ratios don't work for banks.
Okay, these ratios don't work for banks. Okay,
I
got it.
already said it in my my bank class, and
I'm
I'll
sorry.
say it again. Okay, well, just so that I'm clear, let me.
That was just an idea of something that's really different from this. That's the only reason why I said it, but I get what you're saying.
Yeah, I'm gonna take you to that's. Oh, all right, I'm gonna take you to that slide. Hang on. I gotta go to my slide. Where am I? Right here. What does it say at the bottom?
Financial ratios, criteria
No
above are
financial companies.
considered
Financial companies
for
only.
No financial companies.
non-financial companies only.
Yes.
Yeah.
So the reason is like if I say return on equity, return on invested capital, all that stuff, I got to readjust it for financial companies if it's a bank or insurance, and I didn't want to kind of delve into that, right? So for
Okay.
example, if you want return on assets for a bank to be 8% or above, you'll never find one.
Did you say that you don't invest in banks?
Yes, that's correct.
I think I remember that statement. Okay, got it. Okay.
Not because I hate them or anything. All it is
No,
because
no.
because they understand in principle their business model because they play the interest rate spread. Or an insurance company, they collect premiums, and when they collect premiums, those are invested on the asset side of the balance sheet. But then the claims come in a random, right? Depending on whether it's disasters or if it's life insurance company, all that kind of stuff. Now, though in principle, I understand the business model of those industries, but it's very hard for me to understand the balance sheet. Right. So, for example, like if you had when you had the financial crisis, like 2008, 9, 10 timeframe, the banks had loan assets, right? And so on the asset side, they have loans because those are assets. A typical loan is actually a liability, but banks, the way they work is they lend out money. And so now, if things go, wacko, and some of those loans are not going to be paid, they have to mark it as though like, oh, we're not going to collect this, we can't collect it. So they have some adjustment to that. Well, those are all like subjective, right? And so for me, I said, oh man, this is business too hard for me to understand. So I'm not going to play in that arena. So that's my reason for not going into. You can imagine I have to create this kind of ratios for different sectors, right? And so now it's going to drive me nuts. It told me drive me crazy just with this. So I'm not going to go keep doing other things.
So what's your next step? How do you determine the buy price? What price? Yeah. How do you determine the Buy.
You got your PE from your SSG, right?
Mhm.
Uh-huh.
So that's one way, but that's just one way. You have other ways you can value. Like you can look at other ratios such as. So I skip it all the time. So now we shouldn't be skipping it. So here's your price to earnings ratio, right? You can see it each year.
Mm-hmm.
So here's price to cash flow. That's another ratio you can look at. Price to book. There's your PEG ratio. Some people look at PEG ratios, right? So you have a lot of these ratios you can look at. You know, price to earnings ratio is not the only game in town. And the different ratios will give you different signals depending on you know, where your confidence lies in these ratios. Then you can say, okay, based on price to cash, this seems to be reasonable, but price to earnings doesn't, right? So basically you can go down here and you can say, what's the current kind of state of affairs versus its 5-year history versus the index. So you have those kind of things you can look at as well.
Oh.
So you have to determine what makes sense to you and for your club.
No, I want to hear your experience. Like in this case, let's just say if you want to invest this company,
Yeah.
what's your
Price to
expectation?
cash.
What price?
That's your
Okay.
answer. Price to cash. And it's not even in the SSG. Sorry.
Price to cash. So what are you looking at? Are you waiting for it to be like 15 or how do you gauge that? Like,
Well, you got a 10-year history, so you can look at max, min, and average them out and see where it's trending. If it's trending towards the low end, it might be time to start getting in.
you know, but this is the annual data though.
Yeah.
This is the annual. Let's just say next week
But
the
it also
price
has
can go
current.
down.
It also has current on there, so they're looking at whatever the current
Okay, I see what you're saying.
quarters are.
Okay. Okay.
Buckle, I have a very quick question. It's
Yeah.
very, very interesting. I mean, so interesting.
Yeah.
No matter how many financial books I can read, I don't think I would have found this stuff. But in your experience, how long you have been using these ratios, technique, and what is your percentage of success?
I've been
Where
using it for 12 years. Been using it for 12 years.
Okay.
And these ratios haven't come all overnight. It's just like I said, like school of hard knocks, right? So I start with something thinking it's going to work, and I say, oh man, this doesn't work. Well, why didn't it work? Well, I didn't understand it. Okay, well, I need to adjust it. Okay, so it's like an engineering problem, right? It's an iteration. You have to keep iterating until it settles in your brain in a certain way, and then you can start seeing the patterns, right? And so that's the same thing with these financial numbers. It's always iterative, and so you have to keep going at it long enough to kind of see how it kind of is going to gel in your brain, right? So I'd like to give you a like a quick and short answer, but it doesn't exist, right?
Oh, but cool.
I hope you didn't get upset with my question. But
Oh no, not at all.
He's a very successful investor.
No, I just no.
He has a fascinating personal story. He's very
It's,
successful. Let me just tell you that.
I don't know what wrong information Ron has been giving you, Jay. So
So tell us, where did you
Piero
retire?
had a question. Piero had a question.
But cool. You know, when the I forget the company now, they took an impairment charge.
Yes. Which company?
Copart.
They have to file Copart. They have to file a reconciliation, right?
No, they don't.
No?
Why do they do a reconciliation?
Well, isn't when they go pro forma, then they have to file a reconciliation.
Yeah, pro forma is something else, right?
Yeah. Okay. And you find these all in the 10K or 10Q.
Right. If it's like, if it's an impairment that's material, it's going to come out in 8K, right? It'll come out in 8K. So there's your materiality. If it's in suppose they had wrong journal entries and they find out in 2018, that now you have to not only have to do reconciliation, but you have to redo all the stuff from
all of your
yes
statements.
Yeah. So suppose something went weird in 2021 and you discovered it now, that the entries were wrong for something, or you had an impairment charge. Well, you have to restate from 2021 right to current. So that reminds me, I'm glad you asked me that, Piero. So I need to show you something about that. If you're inclined to download these income statements and so forth, so what you have to do is, let's see if I remember this. So here's the income statement, all that stuff, right? Balance sheet. So it's default to income statement. When you expand this thing, you notice you got this exports. It'll give you 5 years worth of Excel data.
Yeah.
On the other hand, if you go through a library through a subscription, it's going to give you 10 years of data. Okay.
Okay.
So just remember that. However, to your question, if it's restated, you notice this one says as original reported,
Yeah.
but here's your restated ones.
Yeah. Yeah.
So just to be careful, so you get, you know, you get what you need.
You should you check both.
Yes, you can check both. Yeah, absolutely.
Yeah.
And then you
Well,
can get your quarterlies also this way.
okay.
You for a subscription kind of a query for a download, you'll get 10 quarters basically.
Right.
Wow.
Bakul, I have a question. Do you incorporate any technical analysis in relationship to the financial analysis?
I hate to tell you this, but SSG has technical analysis because there's price, right?
Yeah,
So,
but wait. Oh, go ahead. I mean, we've
people,
looked at like Bollinger Bands, and we've had presentations on I don't know, Chaikin, moving, you know, MACD.
okay.
Do you use any of those, or do you just strictly go by the financial
I look at all of them.
analysis?
I look at
Oh,
all
you
of them,
do?
but
Okay.
only those things that I have an interest in. So, okay, so since we're looking at Copart, let's see what the heck's going on with Copart, right? So with Copart, what I could do is look at,
Oh.
so here's Copart. So I'm in the cloud business. So whenever something is about the green clouds, that means it's trending up.
Okay.
So so this is a interesting indicator. It's created by a Japanese, I believe, and it's called Ichimoku cloud.
Wow.
So
Ichimoku.
when things are going down like this, it's gonna touch the cloud and start going down. When it starts going up, it crosses the cloud and starts going up. So that's called an Ichimoku cloud. So I'm just giving you a different indicator. But if you talk of MACD, you have a MACD here. You have a cash flow, like cash coming into and cash coming out. So that's your CMF, right? And on the top, on the RSI, if it's overbought, it shows here in green. If it's oversold, it shows like here, right? So these are like watermark, right? Low watermark 30, high watermark 70. If it's above 70, that means there's more buyers than sellers in the short term. And if it's below 30, it means there are more sellers than buyers. So what I'm saying is, yeah, I've kind of looked at all this stuff in the past, and I do get a feel by looking at it, like where the hell, like, so for example, in your Copart, you could have bought this thing somewhere around here, September, October timeframe, even though it looks like it trended down, but then the market suddenly kind of brought it up here. If you notice, like it got overbought here, and then it's hovering like this. And so this is like the 50% mark. If something is above 50% mark, you have more buyers than sellers pretty much.
Okay.
And if it's below the 50, like here, there's more sellers than buyers. So now there's another way to look at it, which is a very ancient way to look at it. It's called the point and figure charts. And so I'm going to show you this kind of stuff. It's a different animal. Uh-oh, advertisement. Screw that. Okay, so what it shows, you notice each of these lines? What do you notice first thing?
Line, what line? The
The X
blue.
and O's.
Oh, X.
X and O's. So an X
sorry.
column means more buyers than sellers, and O's means more sellers than buyers. That's it.
Oh.
And X
Okay.
means it will start going up, or it will stay there for a while
Mhm.
until there's a change in trend. So here's a change in trend.
The O's is
More
coming
sellers
down.
came in. When more sellers came in, it's like a change from 73 to 72. Boom, it started going down, and then it stayed there, and then it reversed. So my point is, this is a different way of thinking of it. Why? Because this is not linear. It looks like as though it's like equally spaced, but it's not. And so one way I can display that is, let me see if I can display that slightly differently. Let's try this.
PNF pattern.
Yeah, so let's try something slightly different. Watch to see how the pattern changed. See, these are not evenly spaced.
Hmm.
A lot of people are used to graphs that are evenly spaced, but why is it not evenly spaced? Because it could stay in one area for a long time before it changes trend. And so the thing is, by default, it's always showing it like this. So in your case, these numbers, like this is July, 7th is July, right? And so if you keep going between July and October is A, okay? Because 9 is September. They don't put 10 here, so A is October.
Oh
Then
dear.
there's November. There's December. Now, between July and October, you notice it kind of went up and suddenly it came down. It stayed there for quite a while in that range. And so it's forming some base here. When it forms some base, it starts taking off. And these are patterns. This is called a 3-point, upswing. So it went 1, 2, 3, and boom. When you see a signal like this, it takes off. So my point is, there's a different way of reading this thing. Now, if you look at the reverse, it kind of went up this way and kind of started going down. My point is, there's a way to read these PNF charts. I don't know if somebody exposed you to this, but I kind of looked at this in the early 90s. And it gives me a feel of where this thing has been, where it's going, where it's hovering. There's no predictive value, by the way.
I saw something like this on a Fidelity call and
Okay.
didn't understand anything about it, but I did see it. And this is on stock charts, which is available to us for a subscription. But this is interesting, but this isn't all you can use. But this is pretty much letting you know, like you said, it took off, and you can see where it took off.
Well, you look
It's
at
like
your
this.
Clearfield. Yeah, you look at your Clearfield. By the way, this doesn't need subscription. I only take free stuff.
Oh, okay.
Cleveland's free.
So look at this one now. So
Hmm.
now you notice you're in 23, and we are sitting in March, and it starts going from 62 to 45, and it kind of hovers around there for a while and continues going down, and now it trended up. So now you can see. So if you change this a little ever so slightly,
Wow.
you see more years. I can keep bringing in a little bit more and see. See, notice I told you these things are not linear. So between 14 and 16, it's been hovering in this range.
Because there was not a lot of activity as
No.
opposed to the other years. Okay.
So these are trend lines. So this is called a bullish line. So when it goes like this, it's a bullish line violation. So from 84 to 81, when it goes like it's a very dangerous sign, actually. Right? So suppose you bought this thing at 100. When you see a sign like this, either you get the hell out because you're preventing this loss, or you stay in there for long term until it comes back. Well, it's got to come back way back towards 132.
Okay.
Anyway,
So how do you learn this?
School of Hard Knocks.
Trial and error. Trial and error.
There you go. Yeah. So I mean the whole okay. I need to step back. There's a gentleman in New York. He is a member of BetterInvesting. He's also a member of AAII. We used to read books online in the old CompuServe days, And he said, you know, we do all this SSG and fundamentals. It's time we look at technicals. So people had this religious war. One side were the SSG and fundamental people, and the other side were the technicals. And then I suggested, you know what, why didn't we just go for it? So he moderated a book that was read, and he assigned one chapter to each person. Okay. So the whole idea was everybody would read the chapter, and this one person would lead that chapter and summarize it and post it. And then we'll kind of keep, you know, asking questions, posting. So that's how this thing went for like 3 or 4 months until we finished the book. And so when we got done with that, we understood what PNF was, like this charting method was, more or less, right?
Okay.
And so we kept on going that way. And if I can, I might have a PowerPoint that he created either for Better Investing or AAII. I'll send it to Jay so she can distribute it to the rest of you guys who kind of learn
Okay,
this.
Okay,
Yeah,
thank you.
that'd be great.
Yeah. Jean,
Okay.
you are very quiet. Do you have any? Jean?
Actually, I really enjoy Baku's presentation and everybody's presentation. I just have a question. I know pencils, are we, the goal is 8 out of 10, and for each ratio, if we have 2 or 3 or more violations, does it mean that we fail that ratio?
Did you guys get the gist of the question? If someone can repeat it, that'll help me. Just kind of broke
Yeah,
up a little
Jean,
bit.
probably not using your microphone. Probably using the laptop. Yeah, can you?
I think she
Something
said
about the financial ratio. Yeah, go ahead.
oh, go ahead, Jane.
Sorry about that. Can
It's
you hear
okay.
me?
Yes.
Yes,
Perfect.
Okay,
Perfect.
yes.
out of 10 ratios, the goal is to achieve 8 out of 10. Otherwise, we will not look at that company, right?
No. You look at the
No.
top 3 that
I know.
that should be
We look at
satisfied.
top 3 and we achieve the top 3. So we continue to investigate. And then if somehow that company fail more than 2, I mean, of course, the exception is that the gross margin ratio that we went over. But
Yes.
then if it's not that, then if it's the other 2 or more than 2 that we fail, does it mean that this company will not be considered?
Yeah, you can choose to do that, but it's subjective for each company depending on the industry, right? It's in. Like in the
Okay.
case of Copart, it failed the 50% gross margin for all the 10 years, but that doesn't mean it's a bad company. Why? Because the
Exactly.
ROE, ROIC, and free cash flow margin already reflects that it's a good company.
Exactly. Yeah. And then for each ratio, if we have 2 years or more than 2 years of violation, then does it mean that we failed that ratio?
Are you talking of just the top 3 or the one below the top?
No, the one below top 3.
You can still pass it if it makes sense to you. Like if you dig into it and the management, you look into the 10K, 10Q or the filings, and if they tell you why something is weird in that year, and if it makes sense to you, you can still pass it.
Okay. And the top 3 then is the 2 violation is the threshold for the top 3. Yeah.
If the top 3, any one of them is unsatisfactory, then you're done. Not good.
1 year, just 1 year violation, that's a
Oh, no,
failing?
not 1 year. If it's
No.
2 years, it's fine.
Okay.
If it's 2 years, it's fine. As long as you can explain it and make some rational sense, then it's fine.
Okay. So 2 is the threshold.
Yeah.
Okay, got it. Thank you so much.
Sure.
And I think it's really wonderful. And the other thing that we always learn, the track record is important, but then the past doesn't indicate the future. So
That's
we always
correct.
have to look at the future prospect of this company.
That's fine. Yeah, that's fine. But here's what I will tell you. If you discover good management, chances are, and if management hasn't changed, chances are they'll continue doing what they've been doing. And in the reverse is also true. If you have really bad management, chances are they're going to continue to be bad. So
Okay, but sometimes it's industry. You know, it's not about the company specifically. It's about the industry.
It's a combination of the two. Yes.
Yes, yes. So how do you find those? I mean, what's the best resources to find the prospect of the company? Where do you go?
You can screen them in like Value Line. You can screen them in FinViz. So you know, you go into Value Line. Hopefully, somebody in your group has a Value Line subscription through a library.
We do.
So
Most
you
of
can,
us do.
yeah. So you can do that, and then you can also go to FinViz, and through FinViz you can kind of find companies with those characteristics. And you know, you're not going to find all ratios as a screening item, but you find the most of the ones that match the one that I have out of the 10, and you can find those. So that's how you can screen them.
Right. And I really think technical analysis is really helpful, but usually we just look at that when we determine when to go in to buy or when we exit to dispose it. So because sometimes I find that these two theories are conflicting to each other.
Yeah. So I think you have a very important point. So I'll tell you a different way to approach this whole thing, which I do, right? Which I do. So the way I do it is on a weekly basis, I just look at the 52-week low. And in the 52-week low, I'll see if I can recognize a company and then look at the ratios. And if, you know, if for some reason, if the market is punishing a good company correctly or incorrectly, I'll identify it in a 52-week low and then put it on my watch list. And I study it for a while. So that's the reverse, right? That's actually doing technical stuff and doing it the other way, right?
Right, right. Yeah, I think that's really, really, you know, it does make sense because a lot of time that the technical guys, they dispose something and I doubt they really look at it and they track it and then go back into it because
Well, I'll
they
tell you
just
what
want to
happens.
minimize.
Yeah, no, I'll tell you what happens when there's significant volume, more than normal volume. So let's say you take a 20 or 30-day average volume, volume in shares traded, right, for a company, but suddenly the volume is like well above the average, like 2 or 3 standard deviations above the average. That means there's some significant news. The problem is the smart money has already done their trades, and we see it later. So the thing is, what you want to do is wait for the thing to settle, see whether the news is good or bad, and then see what had actually happened. Now, are you going to have FOMO if the thing took off? Well, you just got to wait to see what the heck's going on, right? Or you might say, dang, I'm so glad I didn't buy that thing because that thing crashed. So it could go in either direction.
Yeah, I agree. Yeah, but the thing is that it's all about psychology. I mean, if we take a technical approach, then you really have to diligently monitor whatever you already sold because you could have sold something that is really wonderful.
Yeah, of course. Yeah, that's correct. It's both. It's technical, and fundamentally what you can do is each quarter gives you new information. And when it gives you new information, you don't agree with the capital allocation of the management. And if you think the thing is going to go downhill, then you can exit. You don't have to wait for another quarter, another 2 quarters, 3 quarters. If you already think that the management did some major screw up and you don't agree with it, there's no point in waiting.
Exactly.
Because you can deploy the capital for some other opportunity, right?
Right, exactly. Yeah, but for the technical approach, they look at numbers strictly. They look at the price. They look at the value.
Well,
they don't look at
price has information embedded in it, right?
Yeah.
So what does it mean? It's like all things known is embedded in the price. Now, whether you go find those things or whether you look at the price through volume, you're just looking at the same thing from 2 different angles. Basically, that's what it is.
Yes. So for a fundamental approach person like we all are, which technical book a technical analysis book that you recommend that we should at least get to learn about it?
Oh man, that's a big area. I've had no technical books, but I had one, which that book discussion we had, and I'll see if I can.
Share with,
I
the
can dig up
PowerPoint you were
the
talking
name.
about?
Yeah.
Yeah, the point and figure chart, I'll
Mhm.
pick up the name of the author and the name of the book. I have the original first version. This was the
Okay.
time when it was no ETFs existed, okay? After the ETFs existed, the exchange traded funds, they updated the book, which I didn't buy because, you know, I too busy earning a living and doing other crazy things. So I didn't buy the new edition, and I just kept on going, you know, my own way. But it's
Mm.
worth looking at the book, whether it's the latest edition or the original edition. So it looks like I got to give two things to Jay. One is if I can find the PowerPoint from the gentleman in New York and send his PowerPoint to you guys, to Jay, and I'll find the name of the book and the author for the point and figure charts. At least that much I can do because that's what I've done in
Mm.
past.
Yeah, thank you so much, Baku. It's really
Sure.
helpful, your
Sure.
presentation. Thank you.
Hoy and Chris, do you guys have any questions, comments? And then I can open the mic to Steve, the guest. Hoy?
No questions for me.
I'm
Okay.
good too.
You were concerned about the 10K, 10Q. Is this helpful? Tonight's session?
Yeah,
Helpful.
well, the observation, I guess the one question I had was, what points you to the observations to pick on the 5-3, what is it, 5-3-2?
532. Mhm.
Yeah.
Yeah.
So the
Just-
way you do it is you look at the ratios that are not meeting thresholds as required, or if you see something that doesn't look right within a specific range, you might want to dig into that. It doesn't necessarily have to violate, but suppose the return on equity of a company you're looking at is ranging from 15 to 17%. Suddenly one day it's 10, you know, in a given year, or suddenly it's 20, which is more, it's higher than the range, and as we've seen in the past, then you have to dig into that. That's your trigger point.
Okay. Thank you.
Chris, Chris, do you have any questions or comments?
I'm good, thank you.
Okay. All right. I'm going to open the mic to Steve, the guest. Steve Crane, you are self-muted. I don't know if you have a microphone. You can unmute yourself. See if you have any questions. He emailed me, asked permission to sit in. You can also, if you don't have a microphone, you can also type your questions, comments in the chat box. All right, I just unmute him, see if he has any. This is great. This is wonderful, Baku. Every time I learn something new.
Yeah, this is
you.
very, very good.
There's no ending to this, by the way. It's if you want a challenge to learn forever, well, guess what? You met Mr. Market.
Yeah. But this is really the because you know I have been doing this with you. I did not get it. I want to learn it and get it, but now, yeah, tonight I just learned something different, something new, and just keep practicing.
Yeah, exactly. It requires a lot of
Yeah.
practice, and over time you kind of
Yeah.
learn it, and you'll see you'll get better at it. So Jane was talking about the pricing. So like, for example, if you find some pricing that's really weird, like around March 2020, the pandemic kind of, you know, panic time, perfect time to get busy to find good companies on 52-week low list, right? Or if you experience the 2008, 2009, 2010 timeframe where you had a lot of shenanigans going in the banking industry, right? So even though I said that I'm not interested in banks, I mean, I didn't invest in banks at the time, but the rest of the market goes along with it because people panic. So that's where psychology comes in. And so again, your 52-week low list becomes very large, and you basically cherry picking from that list, right? Pretty much.
Yeah.
That's an approach you take from that angle. So you have to be aware of that as well.
So
That's
what
a
do
time
you
to get
think
really
of?
busy.
Yeah, what do you think of the current market?
I don't know anything about the market. I invest in individual businesses, so I don't have an opinion. I don't look at talking heads. I don't do anything. pretty much. Because the market is like it's an aggregation of all the people's betting they're taking on the future, right? But the problem is, if I want to invest in the market, then I'll just buy an index tied to the S&P 500,
Sure.
call it a day, because there's no point in wasting my time. I'm not smart enough to like look at the market. It's too complex for me. Yeah. So
Okay, go ahead.
yeah. So I don't, I don't do that kind of stuff, because even though we are aware that, oh, S&P is here, S&P is there, blah blah blah, but the thing is, if you a silent partner of a business, that's what owning a stock means, then you focus on the stocks that you own and see if they're doing okay over time. And as long as your sentiment is right and you don't do kind of weird stuff and behave weird when prices go way down or way up, then you do fine over time. That's all.
Yeah.
I'm wondering next time you can show us how to how to improve, not improve, what's the word? Look into our portfolio, like PERT, like do you look at PERT, or what are you focused on when you follow your portfolio? Your
I
company?
follow those three top items. I look at the ROE, ROIC, and the free cash flow margin. That's it.
Okay.
Yeah,
But each quarter.
Yeah, each quarter when it rolls in, I look at it on a 12 month basis. That's it.
Yeah, but your previous statement is very interesting. After 2-3 hours of explaining so detailed and so nice presentation, you say you do not use all the things that you explained in your own experience, in your own personal investments.
So I guess I need to understand the nature of the question a little bit better already.
Yeah, all your experience and expertise, you do not use it for your own investments?
Yeah.
Oh, okay.
Yeah, the thing is, like, you have to focus on a few things that you're good at, right? So in order to find that out, I made a lot of mistakes along the way, but then I found a process that kind of works for me, and I articulated that process in terms of these ratios. So, like, for example, if you have a big presenter or investor, someone who's experienced, they'll tell you all the theory stuff, but they don't really tell you like how they practice it. Right? I'm actually telling you how I practice my ratios. It's not a best method. It's a method that works for me, and you have to find what works for you.
Yeah, but you are saying you do not do the investments in these general companies, but you go for some mutual funds.
Oh, okay. So say it again. Somehow we broke up.
Yeah.
No,
Ready? Can you repeat that again?
Yeah, you do your own investments in the ETFs rather than individual stocks. Is that what you said?
That's not what
Individual stocks.
No. So Reddy, I need to explain this to you. I have no mutual funds. I have no ETFs.
Okay. Yeah, so you do use.
He handpicked the best company rather than ETFs and mutual funds. You have one bad apple, and he would rather trust his own research or her own instinct to handpick the best.
Well, the point is this. The point is this, Reddy. Bing and Better Investing, people want to double their money in 5 years, right? So that means roughly 15% return compounded over 5 years. Do you guys agree with that?
Yep, I agree.
Okay. Now I'm going to tell you this: if the S&P is returning 10% over long periods of time, that means you better be really smart to get that 5% difference from 10%. Okay. And so you're going to be doing something different than all the other people are doing in the market, which means you might have to be a contrarian. The question is, do I have the willpower, mental smarts, and the sentimental behavior part in line so that I can get that 5% spread? I don't know. I have to figure that out for myself over periods of time. So
Yeah.
in your personal portfolio, if you're not getting at least 10%, right? Either it's a hobby, right? Or you might say, why am I spending all this extra time when I can just put the money in the S&P 500 index?
Yeah.
That's the idea. It's not like, that's not how I think about it, Reddy. So let me tell you how I really think about it. So the way I think about it is inflation, right? So if you have, let's say, a dollar today is not going to be, the purchasing power of a dollar today is not going to be the same as the purchasing power of a dollar 5 years out. Do you guys agree with that?
Yes.
Great.
Okay. So what I'm trying to do is, for the savings or the portfolio I have, I'm trying whatever I have right now in my portfolio, and whatever it can purchase today, I'd like to have that same purchasing power 5 years out, 10 years out, 7 years out, or whatever that time frame is, right? I can't say 1 year. 1 year is too short because things are too volatile. So in order to do that, I have to say, okay, so if that's the case, what is that inflation rate so that I have to beat? And that really doesn't boil like to the 10% of S&P, blah blah blah. And so it really boils down to your lifestyle. So if my lifestyle inflation rate is 8%, my hurdle should be 8%. I should get at least 8%. Right? So I have to look at the history of all my expenses on lifestyle in the last maybe 5-10 years to say, okay, if my lifestyle inflation rate based on expenses and medical and this, that, and whatever, maybe you're saving for kids' education or what have you. And then you can say, okay, well, that seems to be 9%. Well, then my hurdle, I need to get a minimum of 9% return on my portfolio. If I do better than that, I'll be okay. Right? So that's how I think, which is quite different from what most people think, right? They want to double in 15 and they want to do this, and there's nothing wrong with that. But that's a high bar. That's really a high bar.
Yeah.
Mhm.
I'm sorry to give you that bad news, Reddy.
I know. Better Investing has us chasing that extra 5%.
No, I drank that
Yeah.
Kool-Aid, and that Kool-Aid wasn't sweet.
Mm.
I was
That
just
extra
not smart
5%
enough.
is very hard to come by.
Yeah, look, if you get 10%, you're doubling. If you put money in S&P 500 at roughly 10% over the years, it's not going to be 10% every year. Some years going to be high, some years going to be negative, but averages out to 10% over a long period of time. That means you're doubling every 7 years.
Yeah.
Right? And so a 15% is pretty good hurdle. That means you better know the ins and out of your company. The market zig, you have to zag. If something crashes, you buy. If something goes way up, you kind of exit. So you're not trading. You're doing things like over 3 years, right? And you're taking big positions to get that 15% return. And that's not what BI teaches. It's just that, it's a very hard, long hurdle. It's not written anywhere, by the way. I want someone to give it to me in writing. I don't see it in an SSG guide or help guide. Do you guys see it in writing somewhere?
Mm.
I don't. But well, why do people are touting that then? I have no idea.
Okay, we make this like, this is what I was thinking recently. I haven't figured out how to do it, but to make it somewhat enjoyable and not that it's not enjoyable, learning is enjoyable, but can you make it like a game? And your opponent is yourself, kind of like golf. You're playing against yourself. You're not
Right.
playing against the market. You're not playing against the next person in your group or your team. You're playing. I'm talking about for personal investing. You're playing against yourself. So if you make it like a game, it's almost like it makes it more fun. Is that possible?
Absolutely. It needs to be fun, right?
Yes.
It has to
Yes.
be fun. If it's not fun, okay, if it's fun, then chances are it's a hobby. and hopefully that hobby pays off really good. If it's not fun, then you shouldn't be doing it.
Yep. Okay.
Right? I mean, that's the basis on which you kind of spend time on, right? So I know people, people said they've got this return, blah blah blah, and so forth. And I said, how much time did you spend on it? Right? And they'll tell me X. I said, what's the value of your time? Well, they'll tell me Y. I said, put that in the denominator now. Now what's your ROI? And they said, God, I thought I got 20% return. I'm spending so much time. My value is this. Now it's 8%. I said, okay, well, you have to account for the time that you spend, right?
Okay, I like that.
Yeah.
Wow.
So, but cool.
Yeah.
I wonder if I can just kind of summarize more or less what I heard tonight.
Okay.
Maybe. Okay. For those ratios that you've given us, right? And you're telling us to look at the weird results, when it fails one of your criteria, to look into it and all that kind of stuff.
Yeah.
And we're really trying to observe and try to discover how that company behaves. Like, for example, when Copar, I saw that in 2015 it took on debt. Well, in 2015 the interest rates were about 0. So
Yes.
if you're going to borrow money, of course you borrow it when it's 0, costs nothing.
That's correct.
And then in 2017, 2018, he says, oh, look at his earnings per share growth, and all the earnings jumped up. Sure, they used all that debt to boost their income because they invested in property, machinery, and other things to boost their income production. And then when the interest rates started going high, they paid it all back.
Yes.
Before it got too high. So that's a good company.
Well, absolutely, it's a rational capital allocation. Just think about you owning a house. So, for example, if you bought a house in the late 80s or 90s, the interest rates were 10%, 10 and a quarter, right?
Yeah, yeah.
Okay, so now you buy a house and damn it, it's too expensive. Okay, you buy a house, then suddenly the rate starts trending down to 8 or 7. What would you do? You refinance, right? Because you want cheaper cost of capital.
Yep.
So, and then it goes even down to 6. So then you say, oh, I need to refinance again. So you keep doing it. Why? Because you want to reduce your cost or your fixed cost of your lifestyle, and therefore you have more income available to you, either to invest or save or do whatever the heck you want, right? And that's the same thing. You want to observe the same rational behavior of CFOs at the company level.
Yeah, and that's what
and
we're
it's
doing.
It's reflected in the ratios that way.
Yeah.
Yeah.
Wow.
So now I can tell you something else, right? If you look at Starbucks, tell me, if I tell you Starbucks, what are your thoughts, Piero?
Oh, well, it's kind of interesting because I bought Starbucks when Schultz, when he left, it was like $12.
Okay.
Schultz came back. I finally sold at $89.
Okay.
Yeah.
But what's
pretty good?
Yeah, which was pretty good. But Starbucks, you kind of, you look at it. I haven't looked at it recently, but it's popular. See what their sales are.
Yes.
See what they're selling.
Right.
Yeah, and just kind of look at the balance sheet, cash flow statement, the income statement, everything else, and see if it's any good.
So I want you to tell me about the balance sheet of Starbucks.
I don't know. I don't know.
Okay, let's look at it right now from SSG. Let's start from there.
Yeah.
And this, I'm going some direction, and we'll get to the interest rate kind of. Whoops, if I can type right, that'll help.
While you're pulling that up, last night I was looking at it on Value Line, and I think it's like 1 in safety, 1 in timeliness, and A. And I was so shocked because I remember when it was struggling during the pandemic. So when you finish with that, that's what?
The debt to capital.
Yeah, Piero, tell me what's the story in Starbucks, please.
Oh my goodness.
Lots of debt.
Return on equity, negative.
Right.
Yeah.
So what these guys did, in order to grow their business in China, they took on a lot of debt. Now, I don't say that's a bad strategy or not. It's just that you have an event that kind of throws you off. That event happened to be pandemic. So what happened is from the word get-go, from 2014, you look at the return on equity. It seemed to be 40%. That's pretty high, right?
Yeah.
But then if you look at the debt to capital, it started trending up. So they're taking debt to grow their business. Now the question is that this kind of a structure, so this is a structural problem. In order to fix the structural problem of a company, it's really not good because they're not in a very good position. Why? Because especially now when you have interest rates trending up, the cost of business is going to be much higher and the earnings are going to come down. So the interest costs are going to go up and the net income is going to go down, and it'll be reflected in the pre-tax profit as well. But the point is, if you were, let's say you invested at a time which was 2013 and you thought, well, debt to capital is decent, ROE will kind of turn around, maybe pre-tax will turn around. Suddenly you fall in a coma and suddenly you wake up in 2022 and you see all those intervening years. Should it bother you?
Oh yeah, well,
There you go.
Oh, yeah.
There you
going
go.
up. Yeah.
Now it's a great company with a brand,
Yeah.
but the problem is it has a structural problem from a capital allocation standpoint. That's all it is, right?
Yeah.
So you just want to stay away from something that has I would say a structural problem. In the initial years, it may have worked, but the pandemic threw a curve on these guys. And not only that, the Feds kind of brought the interest rate so low towards zero that these guys took advantage of it.
Yeah.
Which is a reverse situation from Copart. Copart did the right rational allocation of capital.
Yeah.
They took a lot of debt when the rates were zero or close to zero, and then they say, oh, rates are going up, we better get the hell out and pay the debt off, right? Or whatever they're doing. Whereas this one has a problem to do that. They can't do that. They got too much debt on the balance sheet to begin with.
Yeah.
Up to the neck. Okay.
But then why is it so good on Value Line?
What is Value Line saying?
It's saying that I'm pulling it. Their safety is one, their timeliness is one, and their financial strength is A++.
Oh,
Yes,
yeah.
I'm looking at it right now.
So I would disagree with that, with the Value Line
Value Line is
analyst or
very,
whatever.
very, very positive about a lot of companies.
Yeah.
Okay.
Well, basically, what I'm saying is, my job as a business analyst and an investor is preserve capital, right? And to preserve capital, I want to stay away from highly leveraged businesses. This is one of them.
That's right.
Okay.
So,
Okay. So
so I disagree with the Value Line, and nothing says that I got to keep agreeing with those guys, right? I'm investing my money.
yeah,
He's not investing mine.
yes.
He's not investing his. He's getting paid to write whatever the hell he needs to write, but that doesn't help me.
So we're becoming our own personal analysts. And then I did read, I either read it or something yesterday that they can't evaluate, or they can't do a evaluation on a company that they personally own stock in. So basically, that's why we're learning to become our own personal analyst.
Yeah, you got to. Well, when you have your hard-earned dollars and savings that you're risking, you better believe you take an interest in what those managers are doing. It's no different from you betting on someone to be ethical, moral, and you got to remember they have self-interest, right? CEOs also own, they're also insiders and they have good positions in the company. But do you think they'll serve your interest first, or do they serve their interest first? Yeah, they'll serve their interest first. So therefore, you want to watch all those stuff. Like, hey, if you smell something funny and it's not rational, or get the hell out, or don't even touch it with a 10-foot pole.
Yeah. One of the things I heard about Starbucks was that they were treating the company as their own kind of personal family bank account. They were giving, cousins, brothers, sisters loans based on the company.
Right.
Oh.
And then they have to divulge that into the financials somewhere.
Yeah.
Right. But even before going that, if you feel something like this is unsatisfactory, then there's no point in wasting time, right?
Yeah.
Right? And you can look at the same thing through, let's see, you can look at the same thing through, okay, so if you look at that and you can just kind of start top line, right? So we can say margins, you can't expect margin to be 50% plus, but you look at that a little bit and say, okay, well, what kind of margin type of a business am I looking at? Okay, so let me get a feel of that first. before I look at my ROE, ROIC in my top 3. So I'll say, okay, oh, this is roughly a 30% margin business, but it's kind of trending down a little bit from the initial years. And where is it now? See, it's trended down from the 30s into like the mid 20s, right?
Mid-20s now, yeah.
So now it's operating. So now it's all downhill after that. That's why I wanted my 50% because you know, I want a knowledge-based business where they don't have enough money stuck in like inventory and old economy stuff. So anyway, so now you look at the operating margin. You notice it started trending below 10 here. Well, that's explainable because, you know, if all your stores are closed in pandemic shutdown, you can't expect margins to be like before. So that's explainable. So that's not bad. But they're still doing good net margin above 10%. But if you look at the rest, like look at the free cash flow, negative 12, 14, 11, suddenly 40. So you got to figure out why. Did they put more debt, or how the heck do they get more free cash against the sales? And you keep going and you say, oh man, this don't look good to me. So there you go. So I say, I'm not gonna touch this for the 10-foot pole. That's it, you're done. I mean, there's not much to look at after that. But okay, suppose I'm still need to convince myself, you know, because I like the brand. I don't even kind of walk in those places. But anyway, look at ROE. When you see very high ROE, you already know it's the balance is very leveraged, right?
Debt.
Not only that, now it's all dashes. Oh, big red flag. So okay, so let me go look at that. So here's financial health. Oh my Lord, what the hell
20.
happened there?
Ooh.
So now here's your story unfolding. You don't need to SSG, you don't need nothing. You just say, okay, I don't have an interest in this. That's it. You're done. Right?
Yeah.
Okay.
Wow.
So,
Wow.
okay, so anyway, you
I
notice
have a
there's a
question
series
about
of
this.
patterns. There's a series of pattern I look at: ROE, ROIC, free cash flow margin. If I see that's okay, I don't care much about the gross margin too much because that's industry specific. But I do care about what falls to the bottom, and therefore it's the free cash flow margin. I can also look at free cash flow net income. For each dollar of profit, how much free cash flow it's throwing? Is it within a range that's reasonable? The answer is yes. Oh, okay, maybe that's a good sign. If it's all over the place like this, then oh boy, we got some major problems with this puppy.
So what are your view on this company for many years? So when do you consider sell? Like,
When you realize you made a mistake, you get the hell out. That's it.
well, I'm still making money though. Like if say this
Doesn't matter.
company gave me
Doesn't matter
65% return.
because Jay, it doesn't matter because you have better opportunities down the road that will give you better returns. So that's called an opportunity cost. Economists say opportunity cost. If you're stuck in something and you know it's already bad, but you've got a profit position, well, get the hell out and move on something else. That's better. That's the idea. You know, like, okay, so let's say it's a reverse. Jay, suppose the situation is slightly different. Suppose there's a loss position. Now, most people, you know, it makes sense because emotionally they'll say, I want to get back to my buy point. Well, guess what? You got dead money. It ain't going anywhere. Take the loss and make your money in a different way. That's it. It's very easy to say that, but it's hard emotionally for people to get out of a position like that, right? So, I mean, you know, it's just part of learning. You just have to move on. It's not a marriage. You're not married to the stock. Right? So, I mean, so the question is, how do you know if an investing process is working? Forget my ratios and all that stuff. That's just one method. You could have any other millions of methods to make money. The point is, how do you know your method is working? Your process, your investment process, whether you use SSG ratios, how do you know it's working?
Your performance.
Performance is okay, but I would say don't do it on a yearly basis because that may be more volatile. Do it like three-year trailing basis, right? So that we can take care of. But what I'm saying is, the way you can tell your process is working, you trade less, something like you don't turn over the portfolio 10% or more, and that means that your process is beginning to work over time. And when you find good opportunities, you'll have the confidence to go in them, but you'll find those, very seldom. So in the meantime, you're just analyzing, stocks, put them in a watch list, all that kind of stuff.
That means that means you have to be patient to track the stocks that are worthy of being tracked. And once
Absolutely.
it's at the right point, then you get in big position and just wait upon it.
Exactly. That's right. It's like I guess in the animal world, like if you have a snake that hibernates, so it eats, now it's hibernating. It's just waiting behind the tree, waiting for something to eat when it comes, when it's hungry. And when it comes, it plunges, boom, that's your 10% position into a portfolio.
Yep.
Right? So that's how you know your process is working. Now, you're not going to get all of them right, but when you get them right, you'll have multi-baggers over 10-year periods.
Yeah.
Did I wear you guys out? You're all in different time zones, man.
I know. I think it's tomorrow already.
Yeah.
No, give it a minute.
On
I'll
the
have to
East
say,
Coast, I still have 1 minute for it to be today. Okay.
I'll have to tell Isla good morning.
Thank you. Thank you. Thank you.
I think Anitra's East Coast, right?
Yep.
Piero in Canada, and we have 2 more Canadians, but today they are not here.
Okay.
James in Shanghai, Chris in Texas. Oh, Chris moved to Seattle? Chris?
Yes, Seattle.
Is he working for big company now or startup?
He's working for a public listed company, but which have been acquired, so they are going to be privatized.
Oh boy, interesting.
Yep.
Which company?
It's called Qualtrics International.
Oh, is public traded?
Yeah, it's public traded now.
What's the name of it again?
It's called Qualtrics International. Chris, are you there?
What do they do? Publicity
They-
company?
It's a
Surveys.
software.
They do surveys. Yeah.
Yes.
Oh, like a what was that? Some daddy. What's the survey company? The GoDaddy. Not GoDaddy.
Survey
gosh.
Monkey.
Survey
Survey
Monkey. That's what I
Monkey.
was
There you
thinking.
go.
Yeah.
Survey Monkey. Kind of like that, Chris?
Kind of, I guess. Yeah, I think so. It's more like they call it experience management. That's the
Oh boy,
term.
Yeah.
It's like medallion. Yeah.
Oh boy.
interesting. Well, I got a lot of experience. I can tell you I've lost money, but no, I'll read my book. It's not
Have
fun
you written the
telling
book?
people how you lose money, right? So no one will buy a book like that.
Surveys.
Reddy is also East Coast. Reddy is in Florida, right?
Currently, I'm in Connecticut, preparing to move to Florida.
Oh, really?
Those 3 years you were talking about that. He was Doug Gola's neighbor. Doug sold the house, and then you're also moving. And Hoy is in Oregon, right? Hoy?
Well, in Islands, New York.
Hoy,
Yes,
Oregon.
in Oregon.
Yeah,
Oregon.
that's West Coast. Island, New York, Chris.
Yep.
Okay, yeah, we have a few not here today. I think Henny will be really enjoy a conversation too. Henny's based in Canada. He's traveling right now on vacation.
Okay.
He's
We
going to
also
be
have a-
Recording this, right?
He's going to be upset that he missed this.
No, he
Yeah.
won't. He can replay it, right?
Yeah, he could. We
Yeah.
also have a young lawyer, our president, Tamina. He's not here today.
Okay.
Yeah. We have a very dynamic group and a really a good group.
How many accountants you have in your group?
We have a 13.
No, how many accountants?
Accountants. I think a Jane only.
Okay.
Yeah.
Bakul, if you wrote any papers, articles, books, it would be nice to have.
I've written nothing already except for there was 1 year when the Berkshire Hathaway meeting was going to occur. About a couple of months before, one guy sent me an email saying like he was writing a book, and he's been watching me over the years, you know, from the Warren Buffett side, and he's been watching me over from the Better Investing side and so forth. So he invited me to write a case study for a book, because one of his chapters, he wanted to put 3 case studies, and 2 were already done. One guy he chose flaked out on him. So then I told him, what, I'm a second fiddle or something? So obviously he's a nice guy. So basically I said, look, first of all, if you got 2 months in which you're going to self-publish a book, first of all, I have no time. I have some projects where I have deadlines and I can't do this, but I can, within 48 to 72 hours, what I can do is write up a case study for a company, send it to you. If you feel you want to revise it, you have comments, or we need to edit it for whatever reason, I can go 3 or 4 rounds with that. And if it's ready to publish, then you are welcome to include it in your book. And that's the only thing I've done as far as writing something.
I mean, there is so much to digest from your presentation. So,
yeah, it does take a while to gel and digest. So the case study of the company I wrote was FactSet, and you know, he looked at it, and then he sent it to the other 2 people who wrote case studies, and so we kind of went round and round a little bit, and then he accepted it, and then we came out with another edition. What I was doing is I was van pulling to work every day, so I was reading 1 chapter from his book, which is unrelated to my writing, and I gave him a lot of feedback. I think this is not
who is
right,
that?
and this is
Who
not
is that?
right.
Whose writing you are talking about?
Like you know, in his book, I started reading his chapter, chapter by
Whose book?
chapter. This
Whose
friend of
book?
mine, yeah, no, I will
No.
tell you in a second. So what happened is, like, I didn't like the way he presented certain data and certain calculations, and I kind of found some errors. So either error, or maybe it's something that I didn't do right. So we went round and round, like for like, I don't know, 3 months, and then he came up with a new edition with an update. And then he said, "You're not a contributor. I'm gonna roll you up to not only a contributor but an editor of the book. So in the future, what I'll do is, you know, if I need to update it, I can solicit your, you know, your time and stuff." And so after that, I've never done anything. Okay, so basically, when I did that, I was pretty much done. I don't publish anything outside. It's not worth publishing any of that kind of stuff. You know, let me see if I can find. It's been a long while. I don't even contact him anymore, but I know I have his number. I can text him. Art and Science. Let's see if I can find it. It's called, what's the name of it? It's called Art and Science of Value Investing by Scott Thompson. Let's see. I need to share my screen. I'm not sharing, right?
No.
Yeah, I don't think it's worth buying that book anyway. So it's just kind of too old. So, do you see this book?
Yeah, Art
Yes,
and
it
Science
says,
of
oh,
Yeah. So, if you see, like, okay, so I used to be just a contributor, and I basically I told him take any credentials off of me, but he figured out I had an MBA, so he kind of forced me to put it. But I said, don't put any credential behind my name. It doesn't mean anything. So I was a contributor first, and then I gave him so much feedback, I drove him nuts. And then he said, I'm going to put you as an editor as well. And so this chapter here, which chapter is it? God, I gotta think of which chapter is it. Chapter here, chapter 13. So I think it's the second one or whatever. It's a case study that I wrote up on FactSet. So, you know, and that's the extent to which I did publish. Otherwise, I don't publish. So waste of time. Publishing industry is it's a messed up industry. Sorry.
Is
Yeah,
it
because
is this available on Amazon?
it is. I
The
showed it
book?
to you from Amazon. I showed it to you from Amazon. Yeah.
Okay. Yeah, that's
So
nice.
the thing is, like, the publishing industry is like it's a different institution. You send them stuff and they twist it and change it and change the meaning. And I said, you know what? I don't deal with that. If I'm going to self-publish, I'll do it myself. But I don't have time to do that.
Yeah.
So you write a lot about, or not write, but refer to Warren Buffett. And a lot of people, not a lot, a few people,
Yes.
as a professor at NYU that I have listened to sometimes, he's way above my head. But even he has mentioned the concern about the fact that soon Warren Buffett and his partner are going to be out of the business, and what's going to happen to the company.
Well, they have a succession plan, don't they?
Yeah, they do. They
I
have
don't
people back
know.
there that they have people there that they're beginning to hand some of the reins over to already.
Yeah, they have Greg
Okay.
Abel, who's going to be the successor on one side, and then they have the other guy running the insurance already. So they already have a succession plan. They're old. They're gonna put out
Oh,
the
they're very
pasture sooner or later, man.
Yes, we all are. But
Yeah,
yeah,
that's right.
yeah.
So yeah, so I mean, in fact, in each year of the meetings now, Greg Abel and the other person, now there are 4 people that people ask questions to, not just Warren Buffett and Charlie Munger, right?
Okay,
Yeah.
that's good answer.
Yeah, so that's a long, whenever a company is successful with the CEOs and CFOs, the succession plan is always an issue. It's no different from a small family business where the parents or grandparents, whoever, kind of built it up, but the kids want to run it, so you have a succession plan, right? Problem.
Yeah.
Yeah, it's the same issue, even with public companies.
Yeah.
Okay.
You guys
Great.
want to
Thank
continue
you.
for the next 10 hours?
Oh,
No, thank you so much, Baku. I think we should let you go.
All right.
Please.
Well, enjoy, and if you guys have questions, get them together, give it to Jay, and hopefully I can answer them.
Yes,
Thank
sir.
you.
Thank you so
Okay.
much.
thank
All
you
right.
so very, very, very much, Baku. Thank you.
Yes.
It was a pleasure.
Thank you so
Talk to you
much.
guys later. Have a good one.
And
Good
talk to
night.
you
Thank you. Bye.
yesterday.
We
Bye.
have a stock
Bye.
study next month. We have a stock study next month.
Which stock is it?
We have to have a group. Jay, are you still going to lead that group or be in that group? I think Deborah, the new, the prospective member, is going to join.
Uh-huh. I
Is
just
it-
realized I'm muted. I was talking. Yeah,
Who hasn't
I
done
can
a
do this. I can do the stock study, but the problem is though I may miss the meeting that day because I will be traveling.
That's fine.
You still want me to do the stock study?
Yeah, well, okay, but who else is needs to do a stock study that hasn't done one for a while? And I think we should do a more comprehensive stocks, screening to completion instead of reviewing an old stock, so that Deborah gets the experience.
That's why I invited her back.
Okay.
There's
And
yeah.
what about that other woman? Wasn't there somebody else that was interested in?
I don't remember the name. I don't think that person was attended the 2 meetings, even including Deborah, but she's on it today. So she's legit for next stock study.
Where does she live?
She's in California, I believe.
Okay, so is there anybody that hasn't done a stock study? Let's see. So far we have Hanny, John, Anitra, Isla, yourself, myself.
Hey, Henny has done stock study?
Yeah, January.
Oh, do you want to, Anitra, do you have a time to go? Anitra did it was just like a trial version, I don't know if she want to do another one, do the real one, like from beginning to end. Anitra?
Anitra did one in February.
I know, but she did the one as a new member, right? As a trial sort of thing.
Okay. Anitra,
I
are you
don't
still,
know. I'm just wondering.
is there people still on?
Yeah.
Are
And Piero, do you want to do one, Piero?
Well, whatever you guys think, if you want me to do it, I'll do it.
I
Okay.
think that you should do it.
Well,
Good.
Well, what's his name? Amazon reports at July. So,
Oh.
I don't think you're gonna get, I don't think you'll have results until August. I don't think we have any reports due in July.
oh, okay.
There's
So,
no reports in July. That's why we do stock study.
Yeah.
okay, so we'll do a stock study in July.
Sounds good.
From
Okay.
now on until the week before school.
Okay.
Before school, before meeting. Shall I ask Anitra?
Yes.
Located.
So, and then we'll have Deborah.
Yeah,
John, can I help you?
What was that?
John,
Well, yes.
help you stock study?
You want to do stock
I want
study?
to, no, somebody is leading, I will join them.
I will be leading.
John, that was John, right? John said he would do it in July.
John's not here. Wait,
Maybe-
John's going to do one? I don't know.
Piero. Okay, it was
Piero.
Piero, yeah.
Okay. Okay.
I'm going to put you
yeah,
down September. Will you want to do September ready?
No. I want somebody to lead, and so I will help in
Yes,
everything else.
Somebody will lead September. Somebody, and you'll participate. How does that
Wait,
sound?
is September also? Oh, Anitra says okay.
Oh, Anitra, so
Yeah.
you already have.
I know, but I cannot. I may not be able to. If I'm on the road, I'm not able to present.
No,
but at least I can.
You're just going to coordinate. So
Okay.
and then you'll have Piero, Deborah, and Anitra that will be presenting. You'll just
Yeah.
open the process and make sure they understand the screen and all that, because Deborah will be new, Anitra will be just her second time. And Piero, I don't know how many stock studies you've done, but Jay, you'll just kind of supervise the process. You won't do it
together.
You don't have to do any of the research or anything. You just have to coordinate.
I can help. I just that's fine. I can help.
Especially now the ratios and the five. I think we should start incorporating the ratios and the 532 in our stock documentation.
Yes, I was thinking the same thing, and also putting to our quarterly report, the annual report, nothing else, just not the cash flow, that, just do the 532. I'm sorry, the financial ratio, those kind of things. We can talk. Yeah, we may need to modify that.
And ready, I will do supervise the one that's in September. So you're going to be part of that.
We're not supervising. I'm not supervising. We're collaborating.
Okay, whatever. Collaborating.
Collaborating.
You won't be there for the presentation, so yeah, you don't have to.
Okay. All right.
Well, thank you, everybody. Have a great
evening. It's great. Yes.
Okay.
Wait. You didn't explain how to update the SSGs.
That will be
for the treasurer's report.
Okay, can I do that? It's my iClub. So you have to go into my iClub. I think I've done this a couple times.
Yeah, it did.
Don't they have an explanation for it on iClub website?
So yeah, an explanation. Hold on, I'm going to take the screen. And I will document this in the, okay. So you go to my account in my iClub. See where it says establish BI link on the left? You click on establish BI link. And then, so you'll click on, see, I'm already linked. So I guess I can unlink and then relink. So you use your username and your password and you establish a link. Uh-oh, that's my wrong credentials.
Password.
I thought it was this one. BI username. Isn't that my, oh, it's this one. I think it's this one. So yeah,
Oh,
it's,
before I forget, can you please renew my iClub membership? It says
Yes. So I emailed the iClub. What happened was I was going to pay the dues last week, and but Megumi was pending, and I just need a clarification from Megumi, and she paid me. I don't think she's staying, so she just gave me $4. So I called the BI today. Today is closed. It says it's a holiday. I don't know what holiday is
Right.
today. So
Juneteenth. It's Juneteenth. Okay.
what's
Okay.
Juneteenth?
Fine.
I don't know what Juneteenth is.
I'll explain later.
Oh,
Right. It's
okay.
the final end of slavery 2 years after the Emancipation Proclamation. They finally got the word in
Oh,
Texas 2 years later.
I didn't know
Juneteenth.
that.
so
Okay.
going, so it says, okay, so then once you link, then you go to, you may now link your SSG stock studies in any stock you've been assigned to on the My Stock Watcher assignments page. So you go back to home. Let's see.
IMIC.
And you go to reports, stock watcher.
My stock assignment.
Actually, I think it's my assigned stocks.
My assigned stocks, right.
And then you go down here and then you, so I have, you notice I had all these Charles Schwab ones before. Now I just use one, my iClub, and that's what I update in my
SSG.
Yeah, my SSG. And then you just go to submit and it will update it. That's super simple. Want me to go through it again? Go to my account, make sure that you have a link. I think everybody has a link. And then you go to your home, your reports, go to my assigned stocks, and just where it says BI study, pick either your latest one, or I've made it so that if you just pick this, like have one name, every time you update it, you don't have to come in here. It'll automatically update. Does everybody get that?
Yep.
Yes.
You get that, Piero?
Yeah.
Was it Well?
Yeah.
I can't remember who it was.
Well, he wanted to know.
Oh, okay.
Yeah.
Okay.
Actually, I did it today. I updated the price today. So when Reddy presented his first 2 slides, I saw the price for Amazon was 125. But then when he presented the PERT report, the price was 108, which is an old PERT report.
Where's the PERT? Is it on here? The PERT report?
Well, yeah, it should be on there somewhere. Want to look on the reports?
This is reports.
Yeah, PERT, something like that.
Portfolio review.
my price was 2 days
okay.
ago. That is.
So yours is updated, Piero, 6/19/23.
Yeah, because I updated the price at about 4 o'clock this afternoon. So 125 is the price. That's right, for Amazon.
Yeah. Okay.
So I did just what you said, Joanne, right? I have one study called Amazon, and I linked that to the my iClub to BI, and then I just updated the price, and it shows up.
Yep, perfect. That's exactly what you need to do.
Yep.
Every month.
Yep. Yep.
All right. I guess I'll just message Well and tell him what he needs to do.
Okay.
Okay. All right. Thanks, guys.
Thank you so much.
Thank you,
Hey,
everybody.
Joanne and Isla, can you guys, are you able to update the registration link for June's meeting?
Oh yeah, I'll do
Oh,
that
you
now.
know what? Never mind. It's going to retire tomorrow. But next time you need to remember, don't just roll over, copy paste. You have to change the link. You know how you
Okay.
retire, right? You
Okay.
retire for the next time, you're just going to make a copy.
Yeah.
Make sure, yeah, you probably the best practice, just get the link changed. So next time you don't need to worry about it.
And are you talking about the newsletter? Or are you talking about
No,
the
I
event?
don't know about newsletter. I did not look newsletter. I looked the actual website because somebody like Steve, he's interested in our meeting, and I have other 2 friends too. I went on the website, tried to get the link, and I looked at, oh, that's not the same link. So you know how we now use the one that you register once, you get the recurring
Yeah,
reminders? Yeah. So you on a Zoom meeting, you don't have that. You still have the older registration link.
Okay.
I don't remember what you have on a newsletter. Probably you update a newsletter. I'm not sure, but I'm talking about website.
Okay.
We'll get together and do it.
Okay.
Okay.
Sounds good. I gotta go to bed. I gotta
Yeah, I
work.
gotta go to bed too.
I know. Alrighty, guys.
Oh.
Thank you so much. And talk to you later.
Okay.
All right.
Okay. All
Good night,
right. Bye.
everybody.
Good night.
Bye.
Good night. Jay,
Hey, Piero.
Jay, yeah, this stock study that I'm supposed to be doing with Deborah and Anitra, any idea what stock?
I don't know. So we need to follow the process. What we can do is that we can use a Fintra, or we can use a BioEye, set up the threshold, and to
Okay.
see what we get. How does that sound?
Yeah, it sounds good.
Yeah,
So you go to the Better Investing and just pick a stock out there on one of their
that's fine too. But Fintra and the value line may have yeah, you can do that too. BetterInvesting can do that too. We want to set up the domain just like, ROE, the stab greater than 10%. So let's
But
just
you
see
want to
what we
do,
get.
but you want to do it together.
Yeah.
Yeah, we will
Okay.
do together.
But
I don't
actually,
know what stock. We'll do the screening together.
Yeah.
you should, Piero, you should try to do it ahead of time
Yeah.
too. Everybody
Okay.
should be looking for stocks ahead of time. And
Yeah.
then when you go to your screening,
Yeah.
then you can like screen around what stocks that you've identified ahead of time.
Okay.
Okay.
Yeah.
All right.
Yeah. Okay. Good night, again, then, everyone.
Okay.
All right.
Good night.
Good
Bye.
night. Good night.